Hit it.
It's Friday, January 7th, 2022, episode 163. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we have the great pleasure to welcome to the show Wall Street veteran Andy Constant. From his early days at Salomon Brothers to his experiences at Bridgewater and Brevan Howard, Andy walks us through his fascinating career. Then he tells us what we should be watching for as the most important development for 2022. After that, we interview Paul Schulte about his new book, Money Metaverse, How Crypto is Reinventing Finance and Property via Tokenization. Folks, we couldn't fit in Cuppy's Corner this week, but don't fret. Harris will be back next week with all the updates about box wine in the Azores. But the crayon eater himself, Patrick Ceresna, is back with his technical analysis voodoo.
All right. And we end with our segments of no stupid questions and skin in the game. And folks, we might even drink some beers along the way. So stick around. We got a great show. Lena, hop on.
Hello.
What beer am I drinking this week?
So Patrick, the international man of mystery, is drinking St. Arnold Brewing Company's Ye Old Christmas Ale, rich and cheerful. 2 weeks
Yummy.
Too late, but yes.
Oh, it's still on the shelves. I'm out here in Houston, and I decided, well, what would be a great beer, and it's like this is a perfect time to try this out.
So let me say a spiel about this beer. A rich copper-colored hearty ale, perfect for the holiday season with a malty sweetness and spicy hop character. The generous use of 5 different malts is responsible for the full flavor and high alcohol level for this beer. Recommended pairings: fruitcake, Christmas pudding, and squash bisque.
You're drinking the fruitcake beer, Patrick.
It's 7%.
No, you know, it's very rich. I was wondering why my head was spinning here.
Lena, is the merch store still going?
Oh, of course. It's open for everyone. So please visit our markethuddlemerch.com and get your huddle swag on.
It's still going, even after Christmas.
That's right.
Okay, let's do the side effects. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in the show. Side effects of too much huddle may include real rate rash, manic inflationism, and fiscal dominance disorder.
I definitely have real rate rash right now. It's getting really bad. But all right, let's get to the first interview.
It's our great pleasure to welcome to the show someone I've been looking forward to for a long time, Andy Constant. Nice to meet you, Andy.
Nice to meet you too, Kevin.
I've been looking forward to it because I have a look at your resume or whatever you want to call it, all the places you've worked in, and it's a veritable who's who of Wall Street and the hedge fund world.
Thank you. I've seen a lot of things. It's been a great career.
Why don't we kind of get to know you a little bit better? Why don't you tell us a little bit about your upbringing and how you ended up on Wall Street?
Sure. I have always been a quantitative person. Math and science has always been my place where I enjoy spending time, and went to college as an engineer. And when I joined a fraternity, and a couple of important people in my life in my fraternity were heading toward Wall Street.
Okay.
And so they convinced me to take an interview. I had no idea what it was. I had one interview with Salomon Brothers and got the job. And
wow. Okay, so at what point can I ask when this was? Was it the mid 80s?
I was hired in 1986, which is the class after Michael Lewis, the guy who wrote the book about Salomon Brothers.
Right, Liar's Poker, one of the greatest Wall Street books ever written.
Indeed.
And so you're hired
in his class, but I was in the same generation.
Okay. And where did you go to university and what did you study? You mentioned you were an engineer.
Yep. I went to University of Pennsylvania and was a bioengineer, which basically is an engineer that builds medical devices or prosthetic limbs or things of that nature. Sort of a mechanical engineer, but for the human body.
Okay, well, that's kind of fascinating. How did you get the job at Solly? Like, was this out of the norm that they hired a biomedical engineer?
So they were looking to hire more quantitative people. I'll just tell you a funny story. When I joined Salomon and sat down at my desk, I was in the corporate finance department, which was hiring a tremendous amount of people from these schools to do grunt work and crunch numbers on the new thing called Lotus 123, which is now no one knows what that is, but it's now the same function as Excel.
Right.
And when I sat down at my desk, it turned out that I was the first person in the firm in my class to have a PC that had a hard drive.
What did they have before that? I don't even remember. You mean they were running off a floppy disk?
You would have to boot the computer off a floppy disk,
Yeah.
and then once the computer got booted, you would add your software floppy and your saving disk floppy, and that's what everyone else had. But I thankfully had an IBM XT, which had a 10 megabyte hard drive.
Right, megabyte, not gigabyte, folks, megabyte.
Yep.
So that's fascinating. So you were the first kind of generation of quants that they hired on Wall Street.
Yeah, and I think that's I'm very quantitative. I've studied a lot of things. I'm not a PhD, but I think one of my strategic advantages has been, by good fortune, I just happen to be a little ahead of everyone each year as new technologies were brought to Wall Street. And so I was the first person with a Sun Microsystems workstation on the equity floor when I moved over to equities.
Okay, so what I can remember those days very fondly. My Sun Ultra 40 and then the Ultra 80 that I asked for, and the big price tags that came with those. They were amazing machines, and they just blew the doors off of any PCs at the time. Why don't you tell us those initial days at Salomon? What like the era?
Let me tell you the best story. I think it's fairly unique. So when I joined, it was June of 1986. A year later, I had made a reputation amongst my analyst class of 50 or so people as a good person to turn to when work needed to get done, and put in my time. And I got a call soon after the stock market crashed in 1987, the October 19th stock market crash, and got a call, didn't know who it was. It was this gruff voice who was the head of the investment bank, a guy named Jay Higgins.
Okay.
He said, we've assigned you to go to the Federal Reserve and work for them for 6 weeks.
Whoa.
Okay. And so I walked down to the Federal Reserve, and I guess I was assigned a little late. But what was happening was there was a committee that Ronald Reagan appointed to study the stock market crash.
Oh.
And so in the Federal Reserve was the head of capital markets at Goldman Sachs, the head of program trading at Morgan Stanley, the head of interest rate swaps at JP Morgan, a guy from Shearson Lehman. It was headed by the ex-chairman of Dillon Reed, who was soon to be the Secretary of the Treasury, a guy named Nicholas Brady. And then there were a couple of very senior Harvard professors, and that was the team. That was and I came in from Salomon as a 22-year-old kid. Oh, also the head of research for Tudor Investments, who had made a killing during the stock market crash.
Okay.
And so I went in there, and they had already assembled and had started looking through some of the very granular times and sales data of who sold what when. And they basically turned to me and said, as far as we can tell, Salomon caused the crash.
It was all the program trading that you guys did, right?
Sure.
Yeah.
And so, that's where I had met John Goodfriend before on a different matter. And I had met Stanley Shopcorn, who was the head of equities at the time, on a different matter. And so I went back to the firm and made a meeting with Stanley and said, okay, so I've been assigned to this thing. And they said, we caused the crash. And Stanley smirked in his inimitable way and said, it wasn't us. Bring your guys in and we'll have a meeting. And so that sort of that sort of elevated me to being a person who could, play at that in that audience.
Wow. Is unbelievable. 22 years old and they're sending you with all these titans.
Well, yeah, it was bizarre to me, frankly, completely bizarre. Anyway, I spent the next 8 weeks with that team behind me, standing over my shoulder as I crunched spreadsheets, trying to determine. It turned out to be both Goldman Sachs and Salomon had a significant number of clients pursuing what's called portfolio insurance.
Right.
And while Salomon and Goldman did, in fact, bring those trades to the floor, and so were stamped as the broker, they were for clients.
Okay.
And so we were able to identify, and I still can't say who it was, but we were able to identify exactly who was pursuing the failed portfolio insurance strategy, what it did and how it impacted the markets on a tick-by-tick basis, all through these spreadsheets that I was crunching on. Again, this one had 20 megabyte hard drive, and it was an IBM AT. But I was sitting in Jerry Corrigan, who was the chairman of the New York Fed at the time, in his office, got to see the gold, just like they show you in Die Hard. It was a fascinating experience.
That is a fascinating story. Why don't you tell people a little bit about that strategy that those clients, don't tell us who they were, but what they were trying to do and how that differs from today? Because if I understand it correctly, they were trying to replicate what is now a product that you can actually buy from market makers.
So index options were available at the time.
Oh, okay.
S&P index options were founded in 1981, and single stock options had been trading for quite some time before that. And so there were S&P 500 options that were available, but Leland, O'Brien, and Roberts, a San Francisco consulting firm, had convinced a number of clients that the cost of purchasing those options, their implied volatility, was too high. And so it would be better to dynamically hedge your portfolio in a way that is as if you had bought those puts.
Right.
Ironically, what that is when a dealer sells a put to a current institution, the institution now doesn't have to do anything. It's just bought the put and doesn't have to worry about it. But the dynamic hedging process is now done by the dealer. And so there really has been no removal of this strategy. It's just, in fact, become completely institutionalized. But at the time, it was, these types of things are not well understood. And so I think the biggest problem during the crash is people didn't have the foresight to say, wait a second, what are we doing here?
Right.
And so every time the market fell on that day, another basket would be sent, because the job of the portfolio insurer is to sell a little bit on the way down, sell a little bit more on the way once it goes lower, and continue to sell. So you end up in a cash portfolio if things end up, going to zero.
So after going and getting your baptism by fire there at the Federal Reserve, you go back to Salomon Brothers after figuring out that it wasn't you guys that caused the crash, but it was your clients in this dreaded portfolio insurance. And so what was your job when you returned?
Right. So, I had the good fortune of, impressing all the people that were working at the other firms. And at the time, investment banking analysts often went off to business school after 2 years. Yeah. But I had fallen in love. So I said to all the people that I had worked with at the Brady Commission, asked if I wanted to go work for them. But I asked Stanley to whether I could come work for him in the equity department. And he thought the convertible bond trading department was the best fit. I had already done a tremendous amount of work as an analyst and now creating models for convertible bonds. So it was a natural fit, and I began my trading career.
All right. So they put you, do they give you a book, or do they give you clients to call, or how does it work?
I've been a trader all my life. Not really much of a sales guy.
Okay.
And got a book, started working with, this will come back when you ask me about advice for people starting out. But when I joined the desk, the head of the convertible bond trading desk told me to calculate the yield of this particular corporate bond, convertible bond.
Yeah.
So I brought up my HP12C and calculated its yield to maturity and told him what it was. And he said, "No, you idiot, that's not the yield." I said, let me redo it. And so I did it again. He said, "Divide the coupon by the price." And so what he was asking for was the current yield.
He didn't even know.
And so
you were giving him the yield to maturity or the option adjusted spread or like the whole 9 yards.
Those words that you just said were known back then, but I had already started building models to do this. And so I realized that Salomon had a great convertible bond franchise, and there was good people to teach me how it has been done, but I could add value with the techniques I knew how to do to improve our business. And that's pretty much what I've done throughout my career at Salomon.
I have some buddies that were in the convertible bond business, and they talk about different eras, and they talk about how juicy the spreads were in terms of being able to extract the convertible equity portion and isolate the credit and all that versus today, how sophisticated and how tight the market has gotten.
Yeah.
I'd love to hear your comments about how you saw the evolution of the convertible bond market throughout that period, because you would have been there at the forefront, seeing those things get tighter and tighter and people finally figuring it out.
Right. And so what I would say is when I joined, there was one convertible bond pricing model on the street. It was at Morgan Stanley with a guy named Vikram Pandit, who ended up taking over Salomon briefly, being the CEO of Salomon briefly. Anyway, Vikram had developed a convertible bond pricing model, and I had developed one along with a colleague in our quant area that supported equities. So the concepts that were at play at the time were very basic: current yields versus how far out of the money the option is. Really no conception. There was no the implied volatility or the corporate credit spread were not part of the dialogue.
Okay.
And so, those are basic inputs of models. And so I started changing that culture around a little bit.
And where things just mispriced and the opportunities for
arbitrage. You could find the best example I ever saw was Texaco had a 11 7/8 and an 11 3/4 coupon convertible bond, and that Texaco had gone through some major credit problems, and that bond was likely to be called, and I was able to buy that convertible bond, sell an identical equity option that convertible bond had. I didn't hedge the corporate because it was a 1 year thing, and
right,
the credit exposure. But if I had, I would have been able to clean arbitrage 2.5 points of the $100 price of the bond, which that's very unusual, and because of its very unique short-term nature, it was a huge spread at the time.
Right.
Now I would imagine there would be no arbitrage on such a bond.
Yeah, or it'd be 2 cents instead of $2.
Yeah, within the bid offer spread for sure.
Right. And so how long do you end up staying at Salomon Brothers, and how does your career develop there?
Right. So I ran the convertible bond desk. So this is 88. By 91, we had moved to a new building. And the summer of 91, the Treasury bond auction scandal hit.
Oh, yes.
Which resulted in a number of people, John Goodfriend in particular, but also Tom Strauss and John Merriweather, leaving the firm. And surprisingly, the people that really left the firm most aggressively were in the secondary franchises. Like, we didn't see a lot of attrition in the fixed income area, despite the fact that it was a fixed income issue, because the fixed income franchise was so great. And so the equity department became a ghost town, and that allowed me to take over the convertible bond desk, become a managing director when I was 27 or whatever, and take on a significant senior role in the equity department very early in my career. So that was a blessing for me. And then by 95, I started managing the derivatives trading business. Then by 90, then
The
in
derivatives
97,
of fixed income or
equity
equities or
derivatives,
both?
equity derivatives, equity
Okay.
options, equity structured products, corporate derivatives using with an equity underlying, and high net worth hedging strategies, um, listed options, listed futures, listed index product, all the full range of equity derivatives products.
And for those who don't know, originally when Michael Lewis wrote his book, Equities in Dallas was the worst place to be. And
Absolutely.
subsequent to that, equities ended up being the best place to be kind of 3 years or 4 years later.
Well, I don't know about that, but
No, you don't think so?
It was an interesting. Well, I think it all ended up being, for me, it was interesting because I had skills that were valuable and demand in that the firm had lots of opportunity. So that comes back to, what I look for in a career, which is it's great to work for a firm that has tremendous amount of resources in a business that is core that they don't happen to be that great at.
Okay. So you can make a difference.
Yeah. It's very hard to have made a substantive difference in the fixed income area. You more or less rode the wave of a great business.
Right. Whereas on the equities and the equity derivatives, this was a burgeoning new business, and therefore you could make a much bigger.
Right. And there were resources that were committed to it and a firm that had the power to be able to do that.
So you're there. Do you stay there when all the fellows leave long-term? The Salomon Brothers crew ends up going to Long-Term Capital?
Yeah, I got fairly close starting out in early '88 when the guys in the ARB desk started, Eric Rosenfeld and Larry Hillebrand in particular, but all of the guys that ended up forming Long-Term Capital, Victor Hagani, all of these guys were interested in the convertible bond business. They were interested in credit generally, and were talking with the high yield area as well to, widen their product mix. And so, yeah, I had a long relationship with them, and they moved in '94. And, I talked to them about joining. Thankfully, I didn't.
For a little while, you were probably kicking yourself, but in the end, it was probably a good call.
Yeah, by '98, that decision looked okay.
Yeah, so why don't you tell us, 98 was 97 and 98 were both periods of huge instability, lots of volatility, exciting times. Why don't you tell us what it was like managing the equity derivatives during that period?
Sure. So the biggest thing that happened for me and the equity derivatives business at Salomon was that we were bought by Smith Barney.
Okay.
And then within 6 months, we merged with Citigroup. And we also did a joint venture with Nikko Securities in our Japanese office to distribute equities broadly, fixed income, everything to the Japanese retail. And also bought a couple of small businesses, one in Australia and one in Europe. And so I ended up going from a trading-oriented derivatives business with very little client access to possibly the broadest access to clients that any firm could possibly have, which was great. But it also came with many, many different firms with different cultures who were already pursuing the equity derivatives activities.
Okay.
So my big thing in '97 and '98 was going through rationalizing that and building a business and choosing people and integrating them into the business, and dealing with difficult personnel issues, but also tremendous opportunity.
So you were no longer a trader on the floor; you were actually a manager.
Yeah, that became my life through 2003. But I'm not a glass door manager. I spent all my time not behind the glass door, but on the floor. So always had a fairly hands-on relationship with the people at my firm. But it allowed me to travel to Tokyo, to London, Zurich, Frankfurt, Sydney, all around Hong Kong. Really great experience. And I learned what global equity derivatives was about.
And then in 2003, did you leave the firm that you were kind of born into almost?
That thing was built. And the next job for me was to be running the equity department.
Right.
And the equity department in 2000 through 2003 became I'd always expected traditional equity sales and trading and block trading, execution trading to be replaced by a computer. In fact, me and my team were building computers to replace those activities. And I didn't want, if it was going to be the business I was going to run, it was going to be very bad in terms of getting rid of people.
Right. You foresaw what eventually occurred in that, I've heard the famous story that Goldman Sachs used to have 200 equity traders and it's down to 2 now and a bunch of computers.
Yeah. And that's the way it should be. And that's what I was building when I left, but I didn't want to deal with that. And I haven't always wanted to be a hedge fund manager. And a couple of what I would call there were sort of 3 generations of great fixed income traders, Merriweather and his team, and then Rob Stavis took over, and Dennis Keegan took over the ARB desk from New York and London after that. And then a number of other people were left in the business when those guys trading the customer business, and they decided to start a hedge fund. And I said, how about some equity? And joined them.
Right. And so you end up doing that for a while. What's it like being on the buy side now, no longer being the fellow that has to take out the clients, but it's getting taken out?
So I think the number one thing that going from the sell side to the buy side requires is forced patience and high consciousness of paying transaction costs. And the forced patience is the bigger one from an investment standpoint, but it relates to the transaction costs too. When you're on the sell side, you're constantly being battered by various customers who want you to take the other side of their trade. When you're on the buy side, you're constantly being asked to do trades, recommended trades, given ideas for trades. And most of them are not what you want to do.
Right.
And so parsing through that, and I actually would leave the desk in the middle of the day and work out for 2 hours just because I didn't want to take all the incoming calls from the sell side. Respectfully, they did come out with some interesting ideas, and you do need to have a relationship at the time to execute a lot of the things I was doing. But nonetheless,
it's almost like a fire hose of information that you turn on when you get onto the buy side.
Mm-hmm.
And like, I know I see this when you get the research and you're just like, if you go and say yes to everything, next thing you know, your email you're getting 400 emails a day.
Right. And then you can't parse important from small, or it's more difficult to. And I think you also trade more and chew away transaction costs, which are death to a hedge fund.
And so your time at hedge funds is actually included some rather famous names, one of which is Bridgewater. And I'm a little fascinated by their culture and this whole brutal honesty thing. I would love to hear your story of going there, what it was like, and what you think about the brutal honesty aspect of it.
Sure. Well, stepping back for a second, what I saw throughout my career, when I was having my business was having a difficult time, markets were difficult, I was always pursuing relative value strategies. And what I noticed is that relative value strategies all tend to go bad at the same time. And the thing I missed was that macro was something I didn't know enough about. And so my desire when I was on the sidelines during the financial crisis was to learn macro. And thankfully, I was able to get a job at Bridgewater. And I believe they have the best thinking in the world on what drives asset prices, what drives economies, and how to make money, both from a beta standpoint and from an alpha standpoint. And it's a incredibly fun place. I've worked with, legendary names over the years in my career. I've never worked with anybody as smart as the 26-year-old woman next to me at Bridgewater.
Really?
It's a remarkable, remarkable place. And so that's the sort of thing that I look for in my career when I have coworkers, is to learn a lot from them. And Bridgewater had that.
There's some famous saying that if you're the smartest guy in the room, you should find another room.
Mm-hmm.
What was it like in terms of the brutal honesty? Was it just something that, because I've heard you either love it or you hate it. Obviously, you're in the love it category. Did you see anyone, or why don't you tell people, I keep talking about the brutal honesty, why don't you tell people about the culture and what their thinking is behind it?
So I guess this is a principle. Ray writes down all these different things. And one of his principles is around being open and transparent. And another is around not sugarcoating. And I think those are a couple of things that are important. I think and believe, and certainly know Bridgewater thinks, that most of the world says polite compliments to people first. And then occasionally we'll have a but and with some criticism. And Bridgewater just doesn't think that you learn much from being complimented.
Okay.
That you tend to learn more when you've made a mistake. And I get that. It's a hard place to be. You have to be secure that you're loved in the moment while you're taking harsh criticism. And I think the people who don't see the joke, and it's not a joke, they quite seriously want to focus on your weaknesses, not your strengths, because they want you to improve. And they truly do. They're not trying to weed you out. They're trying to get the best from you. And so people who get that, I think, can thrive in that environment.
It's like up here, I'm a Canadian. It's like the tough hockey coach that's just trying to get the best out of his players.
Right. But it has to happen in something where, there's growth.
Right.
If you're just beaten on. And so that comes to the part of the reason why I left Bridgewater. I've had many sessions with Ray or Greg Jensen or Bob Prince, who are the three CIOs and principal owners of the company, where I, heard very difficult things and walked out feeling great. And then, so there's this concept that the apostles heard the word from the Lord and they understood the word. And then they transmitted the word to the priests. And the priests heard the word secondhand and wrote it down. And then the lay read the word. And it really is, the word is different when you're hearing it from the guy that, has done it, or, really has the skills that the firm is built on. And so what I saw is, as the firm grew, there were many hundreds of people who read the word and then implemented the word. And they did it poorly. And it was difficult. And you didn't feel safe, and you didn't feel loved, and you didn't feel that they there were different qualities. Some people did a great job with it. Others didn't. And so I think that's the challenge for Ray and his large management team, is to push the culture down without losing it.
That's a fascinating insight. What about the other challenge that he might be faced with in the coming years if we have a situation where, let's face it, he was the first to understand that bonds is a negatively correlated asset class to stocks. Not only that, they were riding a secular bull market with unbelievable returns as we went from 1982's Volcker moment with the 15% interest rates down to almost zero. And it's been a great opportunity for them to lever up these two perfect assets, which is stocks and bonds. And in his risk parity, has made himself the richest hedge fund manager in the world, and great power to him. But do you think that that strategy's time has come? And B, what do you think will be replaced with?
Sure. So I'm going to break that question down and say, firstly, Ray didn't become rich from collecting fees on risk parity. Risk parity is a beta product, passive beta product with about 30 basis points of fees. I don't know, maybe it's 25 now, maybe it's 18. I don't even know. But low fee product.
Okay.
Where he made his fortune is in the alpha product. And the alpha product is not levered long bonds and stocks. It's just as likely to be short bonds as it is to be long bonds, just as likely to be short stocks as it is to be long stocks. It has no benchmark position besides cash. And you can debate whether he was good at generating alpha. He did generate alpha throughout his entire career. Has had bad years and good years, but at one point when I joined, I think he had never had a down year. He has since. But that alpha product, which is the 2 and 20 product that most hedge funds managers make their billions on, is where their true strength in understanding macro really was.
Could I just jump in here I'd like to understand that product a little bit more. Was that discretionary based upon quantitative data, or was it purely discretionary? Or like, how did it work?
Right. So, Ray's said so many things, so I'm just going to be paraphrasing what he says, but I'll do it anyway. And I could be wrong about how he thinks about it, but I think Ray is more comfortable having a machine that remembers all past circumstances and can unemotionally execute a trade than a person who may not, who may have had experiential learning and gotten lucky. So when I joined, and I had a good job for this, when I joined, one of my roles was to look over the portfolio and make sure it was allocated properly to the strategies, et cetera. And I would say there's, like 99% of the risk is pure systematic. They get input economic data, flow data, price data, and they build models, and those models execute trades.
And can I ask what the time frame would generally, where the range of the time frame would be in that alpha product?
Bridgewater has a longer term time frame on its trades. It's not a Renaissance, which is trying to capture short, high frequency. It's very low frequency.
Right, but is that low frequency a week long time horizon, or is that a month or a quarter?
Much longer.
Oh, really? Okay.
Yeah. Now they trade every single day and adjust and tilt as things tilt, but they don't. It would be very rare for them to reverse a. They manage $75 billion, and sometimes they're 100% long treasuries. To go from 75 billion long and flip to 75 billion short would take, that's a big trade.
Right. Yeah. No, they can't. With clients of that size, they can't do that.
Right. So they might go from 70 to 71 to 68, but the core positions tend to last a fairly long time.
That's fascinating.
Again, the most important thing he was trying to do was, use his research team, which I was a member of, to build systematic indicators. That's what we did for every day.
Now, from there, you end up going to another hedge fund that is almost, in some ways, the polar opposite of
Indeed.
the systematic quant-driven hedge fund. It's more personalities, the old school Tudor Jones, Lewis Bacon, just type traders swinging it around. Why don't you tell us a little bit about that and how that worked for you?
Sure. I wanted to see a fully discretionary hedge fund, and Alan was interested in having me help him. This is Brevin Howard,
right?
Where I worked for 3.5 years before I started this business that I'm doing now. Alan wanted to see if there was anything to systemizing some of the work, the types of trading he did. And so I came in there and started working on generating systematic indicators for him. But I got to see how they think about trading. And, it is very discretionary. Alan has it's done him so well over the years, but it's such an unusual business model relative to the standard hedge fund. Alan goes for periods of years around 0% return. And then, I think it was in 2019, wrote 100% return in a month.
Right. And a lot of it is extensive use of options, is my understanding. Obviously,
if you hear what I said, and you say, you're making sort of zero most of the time, and then all of a suddenly you have a big win.
It's implicit
generally,
in there.
You're talking about some sort of significant convexity.
Right. And did you find that you liked that better, or did you like the discretionary, the systematic ways of Bridgewater better, or were they just different?
Well, I think when I joined Bridgewater, within 3 days, the flash crash happened.
Okay.
I had, obviously, with my experience on the Brady Commission, was able to, make some impact with some people there at the time. But it also created what I consider the greatest opportunity I've ever seen in trading in my career. And that is, there was a massive unwind of long-term, 10-year length equity volatility.
Oh. Somebody was selling it?
Somebody had sold it, Warren Buffett in particular.
Oh, those puts the way back when. That's right. Okay.
Had sold it, and he got a little bit nervous about the
I didn't realize that during the flash crash he decided to buy back some of his short puts.
I'm fairly certain it wasn't then. But I can't get into.
Okay, but in afterwards, sometime around this period, so all of a sudden there's a bid for way out of the money long-term puts.
Also remember, I'm not sure if you're aware of this. There was also a tremendous product called variable annuities, in which the insurance industry sold life insurance that was clipped to a call option, long-term equity call option.
Yeah, we have a big, huge the Canadian industry up here is huge. The banks sell tons of it as well.
Right. And so the reason why Warren, well, let me just step back for a second. That product started in the mid-90s. It blew up UBS, who had been offering the long-term vol to everyone first. Okay. And then that risk got transferred and began to continue to grow and was handed to long-term capital. Long-term capital was short that volatility for a period of a few years and then was forced to liquidate it. And then during the post-2001 sell-off in the equity markets, Warren decided to hit the bid on that vol, because he figured, if I sell out of the money puts here at these incredible premiums and the market rallies, I'll collect the premium. And if it falls, I want to buy anyway.
And he was the one who negotiated the only no more collateral. Nobody could ask him for more collateral on it.
Right.
Yep.
So anyway, the demand side really came from these continuing to grow insurance products. And so that part, everybody had a little bit. And so there became a tremendous squeeze on the long end of the vol curve in equities, enough so that you could sell a variance swap at the equivalent of 38 implied volatility.
Wow. For what term?
10 years.
Oh, so it was a no-brainer for someone like with a balance sheet.
Right. And so Bridgewater, I was there with a firm that had all the money in the world to do the trade and did all the research you could possibly imagine to get the trade done. And Bridgewater looked at it and said, "This is a one-off. We want you focusing on building businesses that are better than the one-off." And the trade went past. And I look at that and say, and since then, the realized turned out to be, I believe that during that period of time, and there were some volatile times from 2010 till 2020. But
it's got to be half, doesn't it?
Realized was 16.
Yeah, I was less than half.
So you sell. There was 100 million bid for, and so you sell that at 38 and realize 16. You're talking about $1.6 billion.
It's a great trade, and those are the kind of things that are so tough for people that don't understand the flows and don't understand what's happening out there. And it's such a few people that can truly take advantage of those sorts of opportunities.
Right. And, I think Bridgewater thought very long and hard about it. I think it was the Canadians actually who ended up doing the trade.
Well, that was going to be my next question. Who pasted it?
I think it was Hoops.
Oh, I know the portfolio manager that was there that did it because the head of Hoops, we used to trade with him way back when. That does sound like a trade that he would have done.
Yep.
Well,
so anyway, so that's the point. The reason I bring that story up is that's not because, hey, I had this great trade, because there were a lot of great trades during 2010. Don't get me wrong. That was one of many. We were coming out of the financial crisis. There was, dislocations everywhere. But that particular one was a discretionary trade. And to build an organization that is entirely systematic, you decide to avoid committing resources to studying a discretionary trade that's one-off and keep your resources focused on, improving your Sharpe ratio from 0.7 to 0.8.
I never thought about it that way.
And that generates far more than the $1 billion that I could have generated on the discretionary trade.
So, Andy, I would love to talk about old war stories all day, but I'm sure some people want to hear what you're thinking about the market. So why don't we from here transition to talking about your views, what you think is occurring. We're taping this. It's just the first week of trading has gone by. It's been a super interesting of this 2022. It's been a super interesting one in that the bond market has had one of the worst starts in a long time. We've seen a tremendous bid to value and a drubbing in the tech and the long-term growth stocks. What do you think's happening, and where do you see the opportunities arising?
So I would step back and say the thing that matters to me, my framework is built on a combination of the major macro drivers, which are common to every hedge fund has this, growth and growth expectations, inflation and inflation expectations, and what I call risk premium, which is a combination of the amount of money and credit chasing assets versus the amount of assets, and the volatility or risk of holding assets as a portfolio. And so I mentioned that because I think the main driver since the summer, the bottom of COVID, was risk premiums, and less so growth and inflation. They moved around, but what really happened was a quantitative easing and fiscal stimulus that there's just never been anything like it and probably never will be. And that flow, which got announced and then came into the market, and it has continued to come into the market even now today, is I think the principal driver for asset prices and the real economy. Without it, I don't know where we would be, but we would not be anywhere near here, both economically and markets.
So I completely agree with you, and I do think it's fascinating that people how quickly everybody has forgotten what it seemed like in March of 2020, when everyone, it seemed, on Wall Street was predicting the end of the world, a collapse in the stock market, a collapse in the economy, and yet we have had, as you mentioned, one of the greatest stock market rallies that we've seen, and even more importantly, the economy hasn't collapsed.
Yeah.
Were you surprised by that?
No, not really. My expectation was, I think that, frankly, it happened sooner than I expected, that we'd reopen with a vaccine eventually. And so my expectation when I told my clients to buy on April 6th of 2020 was that, we'd have 2 years of half the S&P earnings growth that we had in 2019. And stocks had value at that half.
Right. Okay.
And so,
but we've had earnings that's eclipsed that, though.
It turned out that in 2020, the S&P earnings were close to 90% of the prior year's earnings. So, and that's thankfully due to great science and the things that happened. And obviously, without that, we wouldn't be here if earnings had been halved. But that and the combination of fiscal stimulus and monetary stimulus bridged the gap. And what I'd do, instead of rehashing that whole thing, I'd look to my website at www.dampspring, DAMPED, springadvisors.com. I have every single thing I've written about that period of time, and you can see what I said at the time and how it all played out.
Okay, so QE pushed it up to this level. We've had the economy and doing great. We had the markets doing even better. Now we're making a transition from QE, and you did rightfully point out that we are still expanding. We are still in the midst of QE. Taper is not a reversal. It is merely a buying less each month, but we're getting closer and closer to the point where it reverses.
Right.
Is that reverse going to be the end of all this?
Right. So I think that, at the last Fed meeting during the press conference, I heard Jay Powell, and I think I was the first out on Twitter to notice this, say that they had begun talking about balance sheet wind down. Now, that wasn't his direct quotes. People were focused on when rate liftoff was going to happen, how quick whether taper was going to be slowed, and that was the main headlines that everyone grasped. But just a hint that balance sheet wind down, which is called quantitative tightening, was mentioned, changed my outlook for the rest of, until that's reversed. Now, the market looked past those headlines and ignored that faint drumbeat of quantitative tightening until the minutes came out.
Yes.
And all of a sudden, quantitative tightening is upon us. And you look at bond prices and equity prices, and both fell. Bond prices, nominal bond prices, are composed of inflation expectations, which were rock stable during the last week. Not going up, not going down. A little down, actually. and you look at real rates, and real rates have climbed. And real rates go up for two reasons. Growth causes people to want to borrow in a real way against real investment in the economy. And higher growth means higher real rates. Or the important channel of risk premium. And risk premium is the amount of return one gets for parting with cash and buying an investment. And all securities have it. Equities have it. Bonds have it. Gold has it. Everything has it. And what I would say is that almost the entire move in the last week has been on risk premiums going up. And that's consistent with equities going down. It's when risk premiums go up, multiples contract. And it's consistent, and equities going down, and if it were growth that were the driver instead of risk premiums, equities would have gone up.
Right.
But they didn't. They went down. So I'm convinced that there's been a knee-jerk bringing forward of quantitative tightening to today, as if it was happening today. And I believe that's unlikely. For one, quantitative not sustainable would be a better way of saying it. So my outlook is that the drumbeat was faint when I said this changes everything in December, and yet I stayed bullish. I've been max bullish since, or either bullish or max bullish since April of 2020, and I still am max bullish while paying attention to the drumbeat. And the drumbeat was faint when I first noticed it, and so stayed max bullish. And then the drumbeat grew loud, and the market freaked out about it. What I would call a quantitative tightening tapering happened. A tantrum happened this week. That's not what's going to happen. We have significant pent-up savings growth as the original fiscal stimulus goes from consumption to permanent savings. We have continued bond buying. And we actually have significantly lower government bond issuance to fund with that money. And so there's quite a bit of support, or I guess the better way of saying it would be pressure on these all of a sudden rapidly expanding risk premiums to converge back down again before quantitative tightening actually happens. Quantitative tightening, let's just be clear though, I don't want to confuse you, but I am being a bit cute here. Quantitative tightening is kryptonite for assets. It will cause bond prices to go down. It will cause equity prices to go down. It will cause gold prices, home prices, real economy investments will go down when quantitative tightening actually happens. And I say that because that's what had happened the last time. And it makes sense as you withdraw money from the system, and the government still needs to issue its debt, roll its debt, and the Fed is no longer buying, that'll starve other forms of investment and cause a global, and it's global too, markdown of assets. And so that's my 2022 long-term outlook. But and so you could just say, Andy, why didn't you, back in December, why didn't you get short bonds and stocks and gold and everything else? You'd be sitting pretty right now. And the answer is I wouldn't be, because they were lower then.
Right. You're absolutely correct. We've continued to rally. Now,
right. So I think I think that in the first quarter. So you asked me to give my Byron Wien thing. I don't do that, but I'll give you I think this is an outlook that is non-consensus.
Okay.
I think that that there will be an all-time high, probably north of 4,900 in Q1. and that will be the high for 2022. And bonds will 30-year bonds, which are currently yielding 2.11, will tick at 170 before ultimately fading as well on this risk premium problem as equity markets sell off and the quantitative tightening actually hits real growth, so driving bonds lower and quells inflation. So I've always been a transitory inflation guy. Quantitative tightening will kill inflation. And so bonds can rally before they sell off. So I think 170 there. Gold, a very popular asset and controversial asset, I expect to hit 1,600 by the year, sometime this year. So that's my outlook.
As they, in essence, as the Fed tightens and also does QT.
As money becomes scarce.
Right.
As cash becomes king.
So now the yield curve is flattening. And one of the things that seems interesting is that we almost have the bond market telling us something different than the stock market is. The bond market folks are sitting there and saying terminal rate is 1.5, 2. Fed's going to tighten 3 or 4 times, and then the economy is going to slow over real quick, and we're going to roll over. It sounds like you think the bond market is probably a little smarter than the stock market in this case.
Well, if the bond market was right, it would be at 170 now, not 215. So I'm not sure about that.
Okay, but do you agree that
I think there's a world. So I'm super bullish on 2022's nominal growth. Consensus for GDP growth, which is a real number, is between 3 and 4%. Maybe it's coming down a little bit. And inflation expectations are between 3.5% and 4%. And that creates nominal growth of 7 to 8%. Nominal growth of 7 to 8% means the top line of our U.S. corporations is going to be 7% higher, which immediately drives 7% earnings growth. But way more importantly, U.S. corporations have operating leverage. And so they have some fixed costs and some variable costs. Their variable costs are going to go up along, let's just assume for the moment that they're going to go up with nominal growth. The fixed costs are not. And so I could see a year in which you have very robust earnings growth. Current consensus growth, well, the estimate for 2022 is around $2. Sorry, 2021 is around 210 for the SPX.
Yeah.
Consensus growth for 2022 is $225. So $15 more. That seems like it could be way low.
So we get this spurt of growth that then the Fed panics on, and
that's not the kind of growth that the Fed panics on.
What kind of growth is that?
The Fed wants. That's a job. The question is, does it generate inflation? And we can come back to that. But in such a world, equities can do just fine. However, quantitative tightening will still cause multiple contractions. So I can paint a world in which equities do just fine because of this, operating leverage on good nominal growth, way above trend nominal growth, while multiples fall because of quantitative tightening, reducing the attractiveness of assets.
Do you think that the Fed might even want that, though? Do you think the Fed might be looking at it? And let's face it, there are some folks at the Fed that are nervous about the growth in the stock market and the speculation that we saw, especially in this past summer. So,
right. So I think there are portions of the stock market that are highly speculative. I also consider, though I like crypto, I find it an interesting thing. I think a trillion, going from 3 trillion of market cap to 2 trillion of market cap in 90 days that we've just gone through, that's pretty speculative. Yeah. Call it what you will. That's $1 trillion. That doesn't move around very much. Is Apple speculative? No. Sure, it could appear rich, but is it speculative? GameStop, of course, it's speculative, but the center of the court, the S&P 500, with interest rates where they are and the amount of accommodation that's in the system, I could see it being easily 5,200 this year. I don't think it will be, because I think the risk premium is going to start expanding because of increasing drumbeats of quantitative tightening and then actual quantitative tightening.
So here's a question for you. If we get quantitative tightening and the stock market falls because of this risk premium going up, do you think the Fed has changed their tune in that? Will they allow the market to fall because they realize that the market is not the economy? Like, can we have Wall Street and Main Street going in separate directions?
So the answer to that is sure. It can be painful, and it all depends on whether inflation has become embedded or not.
Okay, and what do you feel? What is your outlook on inflation?
So when I think about inflation, so I look at what's happened to prices, not the rate of inflation, prices. And prices have been going up since, now slightly higher than the rate at which they were going up through 2019, but they recovered fully and are still going up. My outlook is that inflation has peaked. The commodities market would tell you that that's likely. And now it's a question of wages and whether there'll be a wage price spiral. Clearly, supply chain disruptions has been a factor, but what I care about and what the Fed cares about is demand side inflation. And demand side inflation happens through two mechanisms, broadly. I mean, there are more mechanisms, but two that I care about. One is wage gains grow more than profits, meaning profit margins come in because there is tight labor supply. The bargaining power of labor overwhelms the bargaining power of those with capital, and wages grow, which allows for higher nominal demand. That could happen. That's something to be concerned about. That's what the Fed's fighting. The other way it can happen is without wage gains, if the government, which is a significant consumer, or the private sector, corporations and individuals, lever not just once, but successively lever year after year to fund consumption today, you can have sustained inflation. And that's something I'm not worried about. Maybe I should be, but I believe that the U.S. government, as one of the main consumers, is unlikely to lever a lot without a real crisis. They can't pass BBB. There will be a political backlash regarding the deficit that the Republicans will use to get elected in November. And if they do, there's gridlock. So I'm fairly confident the government is not going to be levering up to consume. Corporations don't need to lever up, but they're also not consuming. Apple is maybe buying its own stock, which may fuel asset inflation, but there is not a tremendous amount of real economy growth from these companies. And then the consumer has room to lever up, but they've just gone through a near-death experience, and they can't count on government handouts bailing them out in the next year. And so it's possible that they lever up again this year and generate demand side, and it's possible their wages increase. But I don't think that's sustainable. So my call, when I used the term that everyone was using, transitory,
yeah.
I wrote in February of of last year that inflation was transitory, I always wrote that this was a 2021 and 2022 problem, but it's not a 2023 problem. And if so, and you're starting to see that in inflation expectations everywhere. Inflation expectations are no longer going up. Inflation is extremely well anchored in market-based inflation. And so I'm not that, I do expect 2022 to be rough, but I don't expect it to persist. And for that reason, that's those pressures that we talked about on the Fed may allow them some flexibility in the event that markets correct. However, they seem to be on a path. While I expect if we get a cool CPI number, the drumbeat, you'll see some a rally in bonds and stocks, and I think the rest of the economic conditions and the actual flows of QE and the other ones I've mentioned in the first quarter will power both assets higher. That'll be temporary. And then the drumbeat will happen again. In March, we'll raise rates. There'll be an announcement in March about when QT will start. It'll start by rolling off instead of selling. So they have $2 trillion of their balance sheet. Their balance sheet's very different than the last QT. Their balance sheet is much shorter now. And they have about $2 trillion rolling off simply by maturities. Now that'll be a quantitative tightening, but it's different than selling 30-year bonds. And so my guess is they'll start very soon after the March meeting, if not on the March meeting, letting the balance sheet roll down. And then they'll see what's happening. Are inflation expectations falling? Is the labor market cooling? These things all operate with a lag. So I wouldn't expect it in the first quarter or even the second quarter, but they'll start paying attention to that. But to be blunt, until they reverse quantitative tightening, until they stop quantitative tightening.
Quantitative easing. Right now, they're still doing quantitative easing.
No, I'm saying once they start.
Yep.
Until they stop, assets are in trouble.
So you think it's that important? And not only that, the one thing is when they put in a policy, it doesn't stop easily. They'll keep doing it until assets actually sell off.
Yep.
But you believe that it's that much of the driver. It is the key kind of investment indicator or guide like path that you should be watching.
Back in the day when interest rates were high, and the Fed changed interest rate policy, it would have an impact on markets and an impact on the economy. The size of the asset market and the competition that selling down $8 trillion of balance sheet will generate for cash, to me, is significant for the markets, less significant for the economy, but significant for the economy as well. And the only reason I say that is because it's just the opposite of what just happened.
You're spot on there. If you think that the quantitative easing was causing the markets to go up, you have to believe the quantitative tightening is going to cause it to go down. Listen, that's some great stuff, Andy. Let's end with the 3 questions that I'd like to ask everyone. The first one is your favorite investment book.
So my favorite investment book is it has to be Reminiscences of a Stock Operator. I know it's an old nugget, but
it's so good. And okay, the next question is, are great traders, investors born or made?
Made.
Why do you feel that way?
So it's both. So I think being a successful investor, I like to think of it as some combination of a collector of things and a practitioner of games of chance. And games of chance can be learned. Collectors you look at the stock market as a collection of things, and great collectors know what a particular version of this particular thing would be worth. There's tremendous richness of details, and they can look at a huge set of possible things to add to their collection and find that one thing that is truly unique. And I think that's a mindset that is genetic, or at least it's been genetic in my experience. So that's what I would say.
And the final thing is, a young person that's getting into our industry, what advice would you give him or her?
I hinted at this. The first thing is find a firm that is a great firm, down a level, work for someone who can teach you. And then lastly, and this is tricky, hard to do, work for an area of that firm where they have they are not a market leader, and they have a reasonable chance of becoming one, because that's where opportunity will find itself.
Well, that's some great advice. Now, Andy, why don't you tell people about your service, where they can find it, who it's for? Give us the whole spiel.
Sure. So I have 3 lines of product. The first is a free Twitter feed. You can find me at Damped Spring. I am very active and put out lots of educational material, trade analysis, research, talk about the McRib sandwich far too often. And really enjoy and are quite responsive to people who ask me questions. And then I was asked by a number of people to provide a more hands-on experience. And so I launched a private Twitter room. Details are on my main site at Damp Spring. And what that offers is a very limited audience. I have about 150 now, and I'm going to launch about 2 weeks ago. I'm going to have 500 and then close it for good. And that offers much richer content in terms of sharing my way I invest. And that's, again, something that you can find at Damp Spring on my pinned tweet. And then lastly, I have a number of hedge fund clients that get my premier product. And that offers extremely deep research. You'll see some examples of that on my website, dampspringadvisors.com, plus individual firm-by-firm consulting on individual projects or market issues that they are interested in. And that's the range of products. I also manage a model portfolio. It is invested with a single person. Has a 2.5-year track record. I post exactly what I hold in that portfolio as I do it for my public, private, and hedge fund site with very limited delay. And they tend to be, I do about 35 trades a year. And that really holds me accountable to the things I'm saying. And so right now I'm max long equities and expect sometime in the first quarter to reverse that position.
Andy, I'm looking at your Twitter feed now, and I highly suggest and recommend it. It's not often that somebody of your caliber, someone who's been at Brevin Howard, Bridgewater, Solly, all these great places, is so giving with your time. Everyone should go and make it a must follow. It's Damped Spring, DAMPED SPRING. Go follow Andy there. And before we leave, I got to find out your Twitter picture. Are you wakeboarding, water skiing? What are you doing there?
I think that was a wakeboard.
Where is it? Do you have a place somewhere?
It's in the So I have a family house on the North Fork of Long Island, and that's the bay between the North and South Fork, which is a calm bay. We have a motorboat that we park out in front of our beach, and I've been water skiing all my life.
Oh, that's awesome.
Just started wakeboarding, and it's a little more tricky for me, but we'll jump on a slalom ski whenever I can.
So I was like you, Andy. I grew up slalom skiing, and it was always tough on my back, and I let my weight go up a little too much, and so I always found it too tough. But then the nice thing about wakeboarding is you do it a lot slower, and it's such a bigger surface. So I always found it was easier on my back. But then I would, cajole with. I'd find some, university kids to go wakeboarding with on my lake, and they would all do these crazy things. And then next thing I'm trying to Superman and face planting it. And
the thing I want to try, and I need a specialized boat for it, which I'm not willing to invest in, is this wake surfing.
It's so much fun. Everyone loves it. It's all the wakeboard guys a lot of them are just giving up and going and doing the surfing.
Yeah, I skateboarded all my life in swimming pools and ramps and things like that. And so and surfed a little bit, but that wake surfing thing, it looks like just the perfect thing.
Now you're on the ocean, so it won't matter, but on lakes, the people hate it because the boats are very large and they weight them down with ballast, and the wave is just devastating in terms of to the people's shorelines.
Yep.
Anyways, Andy, thanks again for coming on. It was a real pleasure getting to know you and spending time. We really appreciate it.
Thanks.
Take care. It's our great pleasure to welcome to the show Paul Schulte. He's the author of Money Metaverse, How Crypto is Reinventing Finance and Property and Unlocking Value via Tokenization. Paul, thanks for making time for us.
Thank you.
You're the perfect guy because I have so many questions about crypto, about Web 3.0, a million things. It seems to be that although I knew a little bit about Bitcoin when it first started and Ethereum, it's gone off and this next generation is kind of come. And many of us in the finance world that are sitting there staring at all these new young fellas and gals that are doing all these new fancy things and we don't understand it and wondering what's going on. And I figured we should have you on the show to explain to us. So thanks for making time. Let's just jump into it. First of all, what is Web 3.0?
Okay, so Web 1.0 was data, and that was prior to really the explosion in websites. So let's call that up to 2005. 2005 to 2019, 2020 was making content on websites. And what I want to tell you is the designation is HTTP, right?
Right. Okay.
And we all know what that stands for. And so we are now looking at Web 3.0, which is now space, right? Web 2.0 was two-dimensional, right? It was data. Web 3.0 is time and space. It's a three-dimensional world of digitized physical assets. And to me, this is the culmination of the evolution of fintech starting in 2012, sort of insurtech starting in 2016, 2017, prop tech really getting off the ground in 2019, 2020, and all of those coming together with this explosion of crypto. And so if we look back to 2015, let me tell you, give me an example, right, of where we were. I was talking to the head of digital for Citibank,
right,
and in one of the cities in the world, he was a regional head, and he said, let me tell you how behind we are. 80% of our business is still on paper. 20% of our business is digitized. Now, I'm sure that number is much, much, much higher. It probably is 60 or maybe even 70. The point I want to make is 6 years ago, 80% of the business of Citibank was paper. And that is the way it is today with buildings and the way that buildings are managed and the way that utilities are managed and the way that their clients are managed to take up space in their buildings. And so we're still at the very, very bottom of the first inning here in terms of what is digitized, what can be traded and used as assets. And so what is tradable, what is investable, what can be used as a good and service. So we are still, very, very early stages.
Okay, so that's fascinating. So Web 3.0 isn't really it's much more than just a decentralization. It has to do with the move from just it being data to actually things. Is that correct? Have I got it right? Like,
yeah, that's exactly right. So that's a great point. Exactly. So HTTP is hypertext protocol. We have a new thing called hyperspace protocol. And so, yes, I skipped out, but of course it was implicit in what I've been talking about. The world of crypto obviously comes on a blockchain foundation. And that blockchain foundation, none of this would have been possible without blockchain, right? Okay. Because the blockchain is a way to attach digitized assets. And many of them can be physical, many of them are not. Increasingly, most of them will be physical assets that will be placed onto a blockchain-based protocol and will be tradable through crypto. So that's exactly right. Without this, none of this would have been possible. This is Web 3.0 is so much more than blockchain-based crypto trading. That's a small part of it.
Right. So let's talk a little bit about what kind of putting an asset onto a decentralized exchange entails and really try to understand that. Because I think most people understand what it's like to go trade Ethereum or what it's like to go trade Bitcoin. But in terms of making the leap in kind of regards to making it more useful in terms of listing, I've heard of that people are going to eventually, this is where our houses are going to be put on this blockchain and things of that nature. So why don't you walk us through that process? Like, what does that look like in real life? Like, how does it work?
Yeah. So in real life, I'll give you an example. I had a dinner at my house several months ago, finally, when we came out of our endless lockdown. And there were some young men that are in their 20s and maybe late 20s at the most who were made fortunes in crypto, okay? Now, they had made a profound point to me. And one of them said, why would I not want to have crypto-based, blockchain-based digital art, right? And I'm like, okay, continue. Well, a rich person is in their home. Very few people get into their homes. They have very exclusive dinner parties once a month, but they get to stare at the artwork on their wall, which cost $50 million. And by the way, I did not know this. A lot of people, that art is actually not even the real art. The real art is in a vault. The thing on the wall is a replica because they don't want it to be damaged by an accident or fire or whatever, right? And so that's the first thing. And if you come over and you don't like it, tough. I don't care. I like it. I get to stare at it. You don't. And so the exact same thing applies. Why should I not have that digital art that I can look at, that I know that I own as an individuated owner on blockchain, that I am the sole owner in the world of this art? Why would I not want to do that? And I don't care if you don't like it or like it. I don't care if you can't see it. If I want to show it to you, I will. Otherwise, it's my art that I get to enjoy and that maybe I will sell to somebody else. I don't know. And so I found that very compelling, that we live in a digital world where people under the age of even 35 grew up in that world and they're very comfortable in that world. And so they don't have a problem with spending $50 for shoes for their avatar or for $20 to make their avatar jump higher. I mean, there are hundreds of thousands of people in the Philippines who are making $100, $150 a day in competitions with their avatar. But this is real money for these people. We're talking about, $750 a month in a country where the average income in a week, where the average income for a month could be $700, right? So they're making 4 times the average income by dressing up their avatar, by giving their avatar special powers, by making their avatar jump higher or have a better sword or whatever, right? This is the real life effect of what's happening here. And HMV just went into the metaverse today, right? They're doing a digital retail shop in the metaverse, and we've seen what Meta's doing. NVIDIA is going into this in a very big way. And so, I'm not just sitting here telling you what I have seen we have done very in-depth research on like 25 companies that are doing some remarkable stuff here. And a lot of people are putting an awful lot of eggs in this basket. So we really better not ignore this.
So I have more questions to ask, but before you mentioned the art and the fact that a lot of people put, they don't even put the real one up on the wall. And I'd ask your indulgence if I could tell a quick story that I think is a really funny story. Paul Gross, who's the Bond King, he was the head trader at PIMCO for many, many years, got into a terrible fight with his wife as they were getting divorced. And they had a Picasso on the wall. And they were trying to figure out who was going to get the Picasso. So they ended up being that they said they would flip for it. And so they flipped for it, and Bill lost. And he said to his wife, he said, okay, well, I guess I'll bring it by. I'll bring by the Picasso, or I'll get it delivered to you. And she said, don't bother. That's a fake. I've already got the real one at home.
Oh, she had the real one the whole time.
She had the real one the whole time. Okay,
I love it. I love it.
So, Paul, one of the things that when I sit and listen to this, sure, great. I understand the idea that many young people, they're much more comfortable spending money on their avatars or doing whatever, paying for art in the metaverse. But how does this in turn work from a practical point of view in terms of making our society more efficient, or does it?
Well, look, I mean, again, you push people who are very active in this, and they will say, tell me what's wrong with me dressing up an avatar to go into a certain environment in the digital world and meeting my friends as avatars, and I would say there's nothing wrong with that, and it's entertainment, and it's no different than watching a movie that someone's created, and or playing a video game. Absolutely, no, I 100% agree with that. But what I hear from a lot of people is the Web 3.0 is going to change the world. It's going to change everything about how we deal with it. I hear about how decentralized exchanges will change all of finance, and I guess that's where I get a little confused, and that's where I have trouble. Well, see, one of the foundations of blockchain is, don't forget, I mean, we're talking about this thing that's always been in the background of the Bitcoin people, this Bitcoin tribe, and that has been a revulsion and a hatred of centralized power, because those people consider this centralized power to be corrupt. All stocks have to go through DTCC, which is the main company in New York owned by the banks, and all stocks must trade through there, right? Everyone's like, you know what? We're done with that. It's inefficient. It's 50 years old. It's all made of copper. Everyone gets a take. It costs. It's so expensive to do transactions. We're just gonna bypass it. Same thing with SWIFT. And not only with SWIFT, but SWIFT is used as a political weapon all the time. America uses SWIFT to punish people who, it doesn't like.
Right. Why do you tell people what SWIFT is and explain how America?
Oh, so you're right. Yeah. So SWIFT is exactly the same thing as the centralized securities clearing, only it's centralized bank transactions. So if you make an international bank transaction, like even from like Canadian dollars to Hong Kong dollars, you're not even bypassing it. You're not even using an American bank, but you have to have the Hong Kong SWIFT bank, the SWIFT number. You have to have the Canadian bank, code. If you don't have the SWIFT code, you can't make a transaction. This is crazy. Everyone's saying, why? Why are we still doing this? And this was back when it was Pax Americana. People have lost confidence in America as a honest broker in terms of who's on the right side of the law and who isn't on the right side of the law. And so there is an anarchic Marxist, underlying attitude here that must be part of this conversation. You can't just say, well, yeah, but what about the practical thing? There was a philosophical thing going on here that's very important.
Okay, so I think that's fascinating, the philosophical aspect of it. And there's no doubt in my mind when I think of crypto that the desire and the ability to bypass many of the regulations and the inefficiencies that exist today seem to be what's driving it. And my question to you is, when I think about that desire and that benefit, as it becomes more and more popular, it becomes a greater threat to the governments.
Oh, amen.
How do you foresee those two eventually kind of, like, it seems to me it's going to come to a loggerhead, and there's going to be a conflict eventually, and someone has to win.
Oh yeah, I think that's right. I think that's already happening. But you see, for instance, how everybody wanted to control the internet. That worked so well, right? As an example. And the people that I trust, who are either have made hundreds of millions of dollars, or who are deep thinkers about this, that I have got to know around the world over the last many years, since I wrote my first fintech book in 2013, and teaching in 12 universities around the world, I get a pretty good brain trust, and they will say, well, fine, central banks can think they're going to be trying to prevent this from happening, but that's just sheer folly, and they know it. That's why you have like 72 central banks are considering digitized currency, a fully blockchain-based digitized currency. And what was the impetus for it? China's blockchain-based currency system has already been rolled out, right? And but China has decided that the ERMB, whatever, the ECNY, the China coin, will be the sole monopolistic vehicle on which this e-coin, this ECNY, will travel on Alibaba, on Tencent. There was a lot of discussion of allowing Tencent and Alibaba to have a more autonomous structure to distribute the coin. That was vetoed. And so right. China will have this digital coin. Now, the Federal Reserve is way, way, way behind on this. The Bank of Canada is way ahead, way, way ahead. I think the Bank of Canada probably has a lot of questions about what's going on. Singapore's way ahead. But a lot of ECB's way, way behind. But everyone's on the ball on this now. They have to have a solution. But trying to outlaw it is just complete and utter nonsense, especially because now you've got, I would say, 60 million, 70 million users now of all kinds of crypto, probably 80 million. Yeah.
It seems to me, though, that there's kind of two questions or two aspects of crypto when you're talking about these central banks that are willing to or experimenting with or thinking about adopting it. There's the ledger system, which makes transactions very simple and easy and cheap to do. But then there's also the control of the money supply.
That's right.
And it seems to me that those two, the Federal Reserve, the Bank of Canada, they still want to control the money supply, whereas the Bitcoin maximalists, or I think that's what you call them, Bitcoin maxis, they believe that they need to replace the dollar because there's too many dollars being printed, and that Bitcoin is the only true honest currency. So how do you foresee that eventually coming to terms with that? Like, how is the Federal Reserve going to deal with that? Like, let's imagine that Bitcoin did become the standard currency of trade and a unit of trust. Wouldn't that make U.S. dollars not as attractive, and wouldn't that actually be a threat to the government?
Yeah, I think there is mortal fear in the Department of the Treasury about not only that, but the corollary of that is if Bitcoin, which I don't believe is going to happen, becomes like a competitor to the dollar, you're looking at the inability of the United States government to fund itself. Now, by the way, there's about $37 trillion worth of government debt outstanding in the world right now, right? Maybe even 40 trillion. There's 2 trillion of crypto, right? The currency debt markets, right? The government bond markets are, 20 times larger currently, right? And the outstanding amount of debt of the United States government is like 25 trillion. So the U.S. government's debt by itself is like 12 times larger than crypto. And so the numbers are still pretty small, right? But we're getting there. We're getting to a critical mass where it is beginning to matter. Now, look, the Securities and Exchange Commission has a voice, the Treasury Department has a voice, and the Federal Reserve has a voice. And I think the Federal Reserve is saying, you know what, we got to pay attention to this. And the Treasury's like, how about no? We're not going to know. The dollar has to be kept at all costs because we need to fund the deficit. And the SEC is saying, you know what, it's going to happen. We need to make a market here for New York. And so you've got three different entities who are kind of at loggerheads with each other because they have very different agendas. And then in China, you've got a super regulator. The super regulator controls everything, right? The PBOC controls the Ministry of Finance. And it's basically a regulator as well of the banks and has very powerful oversight for securities. And so when you have a super regulator like China and Singapore, you can just say, we're going for it. We have to do this. There's no discussion. And so that's why Canada and England and the U.S. have different agendas. And so there's a lot of noise in the discussion. And that's maybe helpful to the questions you're asking.
In terms of securities law, you mentioned the SEC. One of the attractive points about much of crypto, and it seems to be this new layer of crypto where you can make smart contracts, things that people can bet on. And I'll give the perfect example was when I was shocked when Elon Musk had his Twitter poll one weekend where he said, do you think I should sell my shares to pay taxes? People were quoting the price of Tesla. And I was like, that doesn't make any sense. There's no market open for Tesla. And I realized they were trading a token that was tied to Tesla. And all of a sudden, Tesla became a security token that you could trade 24 hours, 365 days a year, whenever you wanted. But when I thought about that, I was like, well, that security token, theoretically, the reason that we have it listed on an exchange is because there's things like prospectus, there's rules in terms of securities law, there's disclosure rules, there's a million different reasons the way that we have it. Now, you might not like it. You might think that there are too many rules and it should be more just libertarian and, markets are markets and free men for free markets. Yeah. But the reality is that we've learned the hard way, I believe, from 1920s when we didn't have all these rules and they instituted the SEC. So I kind of guess I'm curious of how you think that there's going to be another kind of conflict. And another part of it is that this new technology has enabled securities to be created at an alarming speed. And surely the SEC must look at that and be really worried about it.
I think that's right. But if you look at like the evolution of Wall Street, like, the evolution of convertible bonds or mortgage-backed securities or high-yield debt or CDOs, when I was at Lehman Brothers, but I was in Hong Kong, and recently SPACs. These financial products get introduced. There's accidents. There's a cleanup. Regulations only occur after accidents occur. That's what, with airlines and cars and buses and ships. The regulations come after the accidents. Always, always, always. That's the way human beings are.
That's a great line, Paul. It's so true. Like, that is so true.
Right. And so it'll happen. And I believe all this is going to be incorporated. I think that crypto is going to be treated more and more like a commodity and probably traded more and more like Chicago rather than New York, right? Okay. Where commodities are traded through Chicago.
Right.
And so I think there's that. I think that central banks are all going to be on the bandwagon. The countries that are implementing crypto right now very quickly are the countries with broken banking systems. In other words, you don't have to worry about disintermediating the banks. You were asking about this earlier on, right? If you trade crypto directly through the central bank directly to the retail level, you skip the banks and you skip the whole critically important world of fractional reserve leverage banks, right? And banks lose their power. But in a country like El Salvador, the banking system doesn't function. El Salvador is they call it a fragile state. They used to call them failed states. Now they call them fragile states. And so countries like Lebanon, Northern Africa, Libya, Syria, countries in Central America, countries like Venezuela, they can create these systems without affecting their banking systems because their banking systems are broken. One of the critically important things I learned in LA at the Milken conference, there was a great panel, some of the really bright, very wealthy, leaders in the whole field of crypto. One of the women had a great point. She said, one of the reasons why crypto is so powerful in the world in a lot of these countries is these people are escaping economic violence. Their countries are a shambles. Their banking systems are broken. Their economies are broken. They have hyperinflation. Crypto for them is a way to escape that economic violence. That was a beautiful point that was made, and it's so true. And there's so many countries in the world that are so broken. In Southeast Asia, Myanmar, right? Thailand is kind of being broken. Malaysia is kind of broken. Philippines is kind of broken. Central America, all over the place, right? Colombia is in kind of a state of civil war at the moment. Venezuela is a basket case. 1 out of 4 countries in Africa is experiencing civil war right now, right? Look at Northern Africa and the Middle East. It's on fire, right? These are the kind of countries where young people are saying, you know what? Give it to me. I don't want to participate in my economy. I don't want to participate in my banking system. It's broken and corrupt. Get me out of this. That's where this is all coming from. And that's where a lot of your users of crypto and the metaverse are going to go to.
Fair enough. Paul, as you tell your stories, and I realize that you are just one like me, you're a Wall Street trader that's been around and you've made the kind of transition into this new metaverse, Web 3.0, all this new crypto. You've embraced it. What was the biggest surprise you learned writing this last book?
That's a very good question.
That you were like, oh, I didn't expect that to be the case, and this was, what kind of
what I didn't expect is, we spent months working on it, and then right when the book comes out, all this stuff starts happening. I thought I would have a little bit of time to bask in the sun and say, hey, boy, you were ahead on this one. but the book came out,
the speed upon which it's being adopted it surprised you?
The speed is astounding. It's astonishing. And then you know what the really big surprise is? How asleep people are on how powerful and important this is. People are so asleep on this.
Okay, give us an example of that. Is it just guys like me that are sticking my head in the sand and not embracing it enough, or is it other people that are literally pushing back against it?
Well, I think it's probably the same response that we've had to so many different types of technologies that have been implemented in the world. I'll give you an example. I was reading a really good book about the telephone when it first came out, and you see the old pictures of the women, sticking the thing in the wall and connecting people, and everyone said, "Wow, if everyone has a telephone in the country, everybody's going to be employed as a telephone operator." Well, that's not exactly how it works, right? And so, nobody was going to want to have a PC in their home. Forget it. This is stupid. Nobody's going to want to have color films. This is stupid. Nobody's going to want to have a talking movie. A talking movie is going to be an irritation. People want silent movies. The failure of imagination is one of the great human failings in the way that our psyches are built. We have a tremendous capacity for the status quo. That's the way our egos are very fragile. And so I'm dumbstruck by how little imagination there is in terms of the potential for this. Look, in 1 year, we've gone from nothing to $23 billion in trading volume on NFTs.
Yeah.
There were a year ago, there were 30 networks that support decentralized apps. There are now this year, at the beginning of this year, there's 5,000. So we've gone from 30 to 5,000 in 1 year, and we've gone from less than $50 million in NFTs to 23 billion, right? And I just going to leave you with this. The real world, the physical world is growing at about 3%. What is the growth rate of the digital world, do you think? Do you think it's more than 50? Yeah. Right. Which one do you want to be in?
That's a fascinating point. So, Paul, I'll leave you with one last question that I always ask my guests, and it'll be particularly applicable for you. If you were talking to a young person and giving them advice about entering into our industry now, I'll let you change our industry a little bit, but let's just assume it's somebody that's interested in markets. What advice would you give them in terms of how they should think about crypto and whether they should consider that over a traditional job on Wall Street or Bay Street or wherever?
Oh, if I was like 25, I would go straight into crypto and I would never look back. The faster you get out of a bank, the quicker, the better it is for you. I tell everybody working for a bank right now, your time decay is so rapid. Your skill sets are retarding by the year. And so every year you spend in a bank that you're not doing something related to digital, you're going backwards in your career. This is what I tell people.
And what would there be any specific areas of crypto that you would think would be more attractive for young people to look at?
Well, I think that the explosion is coming. Like companies that are so interesting are companies like Signum, companies like Silvergate. Digital banking is so important right now, right? That these guys want to start creating banking products that are NFTs on blockchain-based initiatives. Right, so blockchain banking is where you want to be. That's where this is all going. So if you want to be in banking, you better be in blockchain banking, or you're wasting your time.
Well, that's fascinating. So, Paul, why don't you tell us about your book? Give us the title of the book, where people can find it. Give us a little spiel before you leave.
Okay, the spiel is that it is called Money Metaverse, and it is available in Kindle, Amazon Kindle. And it is by me and my wonderful colleague, William Dogger, who has gone on to work with Bullhound, which is the fintech M&A boutique. So they're doing great stuff. And the subtitle of the book is How Crypto is Reinventing Finance and Property and Unlocking Value via Tokenization. And we do deep dives into various companies like Tencent, NVIDIA, Qualcomm, Acer, Meta, AMD, Electronic Arts, Microsoft, NetEase, quite a few. So we do like deep dives into like 20 companies and look at all their individual corporate strategies.
Oh, that's fascinating. So there's you go through and talk about how they're incorporating this next wave of technology with the crypto.
Exactly.
And the Web 3.0
exactly. That's right.
Into those 20 names. Well, that's great. Well, Paul, thank you so much for your time. We really appreciate you coming and explaining it to a Luddite like myself.
You're so welcome. No, you're great. Those are great questions. Right on the mark.
Thanks again, Paul. All right, Patrick, it's time for Talking Charts. It's been a long time. People want to hear your voodoo magic. They want to know what's going on.
Well, let's just before we get into all of that stuff, let's actually talk about the top 3 things we were watching a month ago almost now. But you know what? Let's just quickly go through them because we were kind of looking at what to watch over the holidays. Obviously, low volume markets over the holidays. We were looking just to see whether there would be some volatility. And overall, I would say it was a relatively calm holiday week anyway. It could have been much more volatile anyway.
I agree. I think it was pretty much just news fest.
Yeah. Number 2 was would the sector rotation continue? And I think generally it has.
Oh, I think it happened big time, Patrick.
Yeah, absolutely. It's underway. We can pull up some charts on it in just a moment. And number 1 is the gold bottom in. Well, maybe the gold bottom is in, but certainly not a new gold bull market yet.
No, I think just keeps disappointing. It's probably because we put a number 1 there.
Yeah, it's because we put it number 1. And
let's just stop talking about it.
Let's just do that.
I'm sure all the gold bulls will be really happy, and then the gold bears will probably be happy because we just talk about it constantly. All right, so what do you got? All right, let's go through the charts.
Okay, no, top 3 things to watch.
Oh, yeah, that's right. I forgot to put all this work into this.
Well, there you go. But anyway, what I thought was really interesting was obviously a part of this big rotation has been this momentum over value factor that has just been moving like crazy. Here's the chart. You can see this is the 2 ETFs, the MTUM and over the VLUE, which is, and really just ever since that peak in October and throughout much of this market correction that occurred in November into December, it just hasn't quit. This money is clearly leaving momentum and finding value, and it's just accelerating. We're at the levels that we saw at the bottom of 2021. And the bigger I mean, I know the answer to what you're going to say, but like, is this just a new trend that's going to still stay in place and remain intact for an extended period of time? It's certainly something that's on the back of my mind. What's your thoughts?
Well, now that I see this chart, it's pretty amazing how far it's fallen, and when you get something like that, chances are we're due for a bounce. But if you're asking me,
but it's not an oversold stock; it's relative values, right?
I understand, but it's still it's moved a long way. So, are we due for some mean reversion? For sure. Do I think this is headed a lot lower? Doubly for sure.
Yeah, it's moved quite a bit, but this is a weekly chart, so we can see like that entire period from 2017 through 2020, you had to be long momentum. Like momentum was just crushing it all the way through, and even into the early post-COVID reaction. And really, this trend has only really started in the post-COVID period, but we are clearly seeing that rotation well underway here.
Can I put on my my technical analysis, my limited technical analysis?
Please.
Can you pull that up again?
On the weekly?
Go back to the weekly?
Yeah.
You know me, I don't have a lot of rules about technical analysis, but the one rule I do have, there is no such thing as a triple bottom. So that looks like it's trying to do a triple bottom, which therefore means that can't happen.
You know what? Well, I'm going to crush your hopes
that
and
a triple
dreams.
bottom.
Well, you're not allowed to, because triple bottoms happen at bottoms, and this is nowhere near.
No, but if we
bottom.
just look, there's the 1, 2, and then 3. I see 3
but
there.
okay, so you're saying a triple bounce at a support.
Okay,
that's not
triple
a bottom.
bounce at support. I'm sorry that I used the wrong language. There's still nothing. There's no such thing as those. They are elusive. They are like unicorns. Nobody's seen one in the wild. Okay, number 2.
Number 2. Well, we got CPI, PPI, and even some retail sales coming out all next week. Obviously, inflation's been the big story of 2021, and will it continue, or will we finally see that things have just stalled? I'm not actually looking for a collapse of inflation numbers, but the thing is that are they going to just keep gaining traction on the upside, or are we finally seeing that rotation? Well, it's stalling out, and the numbers start coming in a little bit more shallow. What's your take?
Patrick, I'm actually scared because we're green. I think we've hit the point where inflation expectations over the short run are going to start to be, we're going to start to see some surprises the other way. We're there.
Yeah.
Like, and that's what I'm saying. In the past, I was pretty consistent that all the surprises were going to be to the positive. They were going to be bigger, and they can still happen because there's no doubt about it. The variability and the volatility around inflation is huge right now, but it's been a while. We've had some improvements of different things. I could see situations where we now start to see surprises the other way.
Well, listen, you've grinded me on this before, but one of my favorite ways of kind of generally getting the direction right is just by watching crude oil prices. And the one thing that if crude does break to a fresh, a new high, like above the 2021 highs, and runs, that could contribute to inflation staying hot for a little bit longer. I'm going to be watching whether or not that oil chart peaks out along its highs or not to kind of really give a bias. Do you?
I'm not going to give you too much flack, but I do want to say that I am talking versus expectations.
Yes, of course.
And that's the thing that everyone has to remember. I don't want to hear, well, inflation, I don't know what they're expecting next week, but let's just imagine they're expecting 7 and it ends up being 6.9 and everyone says, look, inflation's 6.9. Yes, I agree, but it's what it's what the number comes in versus expectations. And in the past, we've had increases and surprises were to the positive, meaning that the market got caught off guard. It ended up being that it was more than everyone expected. The market has a way now, after getting nailed that way, of kind of getting surprises the other way. And that's what I'm starting to be on the lookout for and ready for.
Right. So number 1, will the bond market selling continue? And this is a twofold thing. I mean, number 1, let's just start with the 10-year yield, just because it's the most commonly watched. But it's attempting to break above the 2021 highs. But really, the move has to be in the shorter durations, right? The 5 years just ripping on the upside, at least on the chart basis, and the 2-year just doesn't want to quit. And so it really is all at the front of the yield curve, because the farther you go out in duration, the less responsive it has been. And that's obviously these inflation numbers being baked in. But these bonds are collapsing. Not collapsing. I guess I don't want to use such a descriptive word, but they're definitely in a massive I'm using mass downtrend. They're in a downtrend, and they're weakening. What's your take on all of this?
Well, Patrick, you know me. I'm the biggest bond bear there is out there, and if we're thinking about it,
only problem is you were 4 years too early. I remember
4 years too early.
2018 Chicago. I remember this bond bear standing on a stage. And,
I guess I didn't foresee the COVID, the worldwide pandemic. I'm sorry about that. I'll get that right next time. And I'm glad that you foresaw that. That's why you were so bond bullish, and that you rightfully turned bearish right at the right time as well. No, but kidding aside, there's a lot of noise in the first week of the year of people getting their positions on. I'm a little nervous that it's become very quickly almost kind of the cool kids trade to have the bond short on. And you know me, I hate being part of the cool kids. I like hanging out with the D&D guys. I don't know, Patrick. I am short. I hate bonds over the long run. I do think there's a chance that next week we find that we get a bounce, and that's I know that sounds a lot like what I was just saying on the other asset as well, but I just worry that we've gone so far, so fast, so quickly that these trends for them to just continue out of the gate another week like this, geez, it'll be pretty ugly if it does happen.
All right, so listen, let's continue this conversation as our normal talking chart segment. And let's kind of really touch on the whole bond thing and some of these other side effects of this kind of a bond move. Well, first of all, I wanted to highlight that it's not just Treasury that is doing this. And let's just take a look at corporate bonds. When you're using the LQD for investment grade corporate bonds, we're approaching the 2021 lows.
Now, so I'm going to push back and stop you right there. It's important that we look at the spreads, though, because if there's no widening of spreads, then it is purely just a function of the 5-year note, which I think LQD's duration is 5 years.
Yeah, so I actually have the credit spreads already loaded up. We're going there.
You knew it.
Yeah, I knew we were going there.
Okay,
and that was an observation we were going to make. But you're right, though. You're right. And I'm in agreement with you. But I wanted to also highlight the fact that the junk bonds are relatively weak. They haven't broken that December low. But we generally have pretty broad bond weakness, and it's when you look though on the credit spreads, I'm just going to focus on the junks. When we had junk blowout in November, December, we hit on the credit spreads on the junk bonds, well over 360 basis points, and here we are still around 3%. Just over, and so this is not a credit shock from quality or some other element. This is completely a response to higher interest rates as an aggregate. At least this is.
I completely agree. So when you're looking at the weakness in the LQD and the J or at least with the junk, I don't know. Now, are you going to do the LQD spread as well? Are you going to do high investment grade?
We can, sure. Which one do you want to look at here?
So you do investment grade. You
want me to do?
You don't have a general investment.
No, I'll do a broad one.
So that's actually it's
down.
Narrowed.
Yeah, it's narrowed.
So in essence, investment grade bonds are outperforming treasuries.
Mm-hmm.
And that just says everything. So that says everything you need to know, that all of these moves are duration based. They're yield based moves as opposed to credit based moves. So don't get too excited when you're staring at LQD and junk.
So now we've seen in the past, so this is where I want to kind of put something else on the radar. We've seen it in the past where the bond market starts to sell and rates start going up and the stock market initially doesn't care. And then the trend continues and the stock market doesn't care. And then inevitably, usually on some sort of a lagging basis, anywhere from three weeks to a couple months, suddenly when the stock market just there's this moment where suddenly everyone cares and the stock market has a freak out. And the bigger question about whether this trend continues, if bonds continue to remain under stress and rates continue to rise, my question is, when do the stock market start to give a shit? Or will they even?
Well, eventually they would. There's no doubt. There is a level upon which higher rates cause the stock market to give a shit, as you say. I don't know if that's a technical analysis term or not.
Oh, it is. It's when you chew.
And I think it's a great question, Patrick. And I really do think it's the question everyone should be asking themselves. And it's easy to argue that if you look back in 2017 when Powell did his, we're a long way from neutral.
Yeah.
Eventually the market cared. He kept raising rates. But one thing to think about is we're not even raising rates yet. Yes, the bond market is anticipating rates going higher, but we aren't raising rates. Yeah. And even when it comes to the balance sheet, everyone's getting the stock market sold off because the Fed recently has been talking about reducing the size of their balance sheet, but we're still expanding it. So my question to you is, if you're expecting that to happen right now, how vulnerable do you think the stock market is to the Fed's policy decisions?
I'm gonna have to get another beer to think about this one.
No, but you hear what I'm saying though. Like the people that are getting all bent out of shape now are in essence arguing that the stock market is completely and utterly dependent on the Feds to the point where we can't even have them talk about potentially doing quantitative tightening in the future because it'll sell off today. And I'll just tell you that in the past, you would always, what was it? I think there was Martin Zweig had a line. He says three steps in a stumble, meaning it was the third rate hike that you wanted to sell because that was when the stock market would finally react to the rate hikes. And I was listening to somebody on Bloomberg the other day, and he had a great point. He says, you don't want to sell the first rate hike. You want to sell the last rate hike. And to me, I'm thinking to myself, okay, I those are all great, wise, kind of pithy sayings, but we haven't even got there yet. And it could be that we've become so addicted to quantitative easing and so addicted to easy money that we actually can't get there. And that would be one argument. But another argument could be that the reality is that the market is, all like a cat that's wired too tight. And whenever someone opens the door, they freak out and run around. But at the end of the day, they're still in the house. And that would be kind of probably where I would end up. How about you? Do you think think that the stock market will fall to the point where they won't even be able to execute the first hike nor the first quantitative tightening?
So the question I think about is, like, where is the state of the market? Because, like, if the market was an incredibly vulnerable state, then that could be all it takes to trigger a market reaction. So, like, if the market was at a stable state, ready to go, and hasn't been overcharged to the upside, then it could survive 3 to 5 rate hikes and before it starts getting responsive. But I'm curious whether the fact that we had such an incredibly huge surge in the markets and so much leverage in the system, that all it does is it takes a little bit of nervousness to already stall it out. I mean, I'm not sure I want to stand by that statement, but I'm just asking, like, could it be play out that way this time around?
I think it could. Listen, I'm not denying it, Patrick. I'm just kind of thinking out loud about the absurdity of this, that we might not even get to a point where we actually can raise rates because the market immediately freaks out. Now, you might say as well that, we're assuming that the Fed reacts to the stock market going down. Maybe they don't. Maybe they just keep and we get a repricing of the stock market.
They are going to react, but where I believe that if anyone thinks they're going to be reacting after a 5 to 10% drop is where I'm a seller on. I think that this time around they're going to wait longer.
So you think the put is struck way more out of the money?
I think so. It's an out-of-the-money put. Like, if you think about it, after the stock market in just over a year and a half runs 100% to the upside, they're going to respond with after a 5% drop? No way. They're gonna wait until it gets to a scary point where there could be some serious long-term effects if they don't step in. But I think that they're gonna let it drop a little bit more than people are expecting.
And so that sounds like you might be getting a little on the dark side.
But the thing is, I don't see the technical. Okay, when the technicals turn down, I'll have more conviction on the bear side. I'm not ready to turn bearish already.
So why don't you show us a chart and tell us what you'd be looking for there?
Yeah, for sure. Let's talk about it. Well, okay, let's start with the S&P 500. And overall, the S&P is still in primary trend, making higher highs, higher lows, above its 50-day moving averages, holding above fib zones on retracements. There isn't yet any price action deterioration on the S&P chart that would already be saying that the sell-off is already underway and you have to be short right now. But one of the things that I'll be watching, like what are some of the areas at least that are concerning, is when you then, let's say, go to the NASDAQ, and not only did the NASDAQ fail to make that higher high in that December push, but gave back the entire rally in that. So you're seeing in that rotation thing that you've talked about, all these tech selling, that the NASDAQ is actually already deteriorating a little bit. But then when you go to the broader stock market, using the small caps as an indicator, that entire rally over December, it couldn't even muster up a 50% retracement of the decline.
Yeah, I will be on your camp here. This is a shitty looking index. It keeps disappointing.
Yeah, and so while the S&P or you can poke your fun at me, or let's say the Dow Jones, when you look at it, it actually still looks bullish. Right? Yeah, okay, go for it. I'm just going to pause here while you take your rib on your usual Dow Jones. Go for it.
You've been watching too much Mad Men or something?
There you go.
Like, here they liked it as well. They would talk about the Dow Jones.
Okay, so, but the point being is that you have the S&P and Dow that are relatively bullish charts. NASDAQ looks heavy, and the Russell looks like shit. And so and even when we go to breadth indicators, I didn't have it set up here, but when you look at, let's say, the number of stocks above their 50-day moving averages, it's still around 50%, which means that half of stocks are in a downtrend.
Yeah, based on that, half of them are in an uptrend, though.
Yeah, but usually during a bull market, you're
pressing 70,
right. 90%.
It's extremely narrow, and you're right.
But we should talk about these sectors and which ones are moving. Like, for instance, okay, let's switch actually to some sector analysis and look at some of the different sectors in the market. So obviously, the technology story is the same as that NASDAQ chart. But what I want to just highlight is social media on a global basis has been in an awful downtrend. Obviously, too many China plays in the basket, but the social media index has just been an awful bear market. But you know what? I remember this one guy, this macro tourist guy that was.
He's annoying though. You shouldn't listen to that guy.
He's annoying.
Yeah.
But he actually was giving a plug to the financials, and it's been working.
Jesus Christ! I can't believe he actually got something right. That guy's a dope.
Yeah, but
I hear he liked the KRE the best. What does that chart look like?
What? Yeah, it looks pretty good. So the point though, that it's interesting that the financials are rock and rolling here. They clearly like this market environment, and that's also interesting is that the Canadian banks are running too. Did you? I guess did you watch like the way Royal Bank and others are running? Like,
you know what's funny, Patrick? I was talking to I can't remember who I was talking to, but it was some New Yorker, and he was telling me how he can't bring himself to buy U.S. banks, but he thinks that the Canadian ones are pretty well run, and he might buy one of the Canadian ones. And I was like, I feel the same way. Like, I can't bring myself to buy Canadian banks, but I can buy the American ones. I feel like it's a home bias negative, like a home negative bias.
Yeah, you don't want to buy your own banks. Fuck.
Yeah, our banks are expensive, and yes, they're behaving well, they're trading well. You're absolutely right. Royal Bank. Interestingly enough, Royal Bank is Canada's largest stock again. And for those who don't know, there's this Royal Bank curse. Whenever a stock gets bigger than Royal Bank, it eventually collapses in just a terrible amount of shame. Like, no, there's like
Nortel.
A long list of it.
No,
Nortel, was it BlackBerry? I can't remember. Yeah. Was it BlackBerry? And recently, what was the Valiant, the pharmaceutical company? And do you know who was the biggest company last year in Canada?
Shopify, right?
Shopify. And now it's
the curse.
It's gone back. Royal Bank has said, I'm convinced it's something. Those bankers at DS, they do something. They when they see it, they do something to the corporate finance, and they spread some rumors or something.
All right. Well, let's look at that chart of Shopify, and you can clearly see that this thing is just diving off of its high.
It's a Kathy Wood special, by the way. It is. It's a big holding.
Oh no! It's been cursed. All right, there you go.
Anyways, you were talking about the different sectors, and I got you off track. I'm sorry about that.
No. So let's do this. All right. So listen. So this consumer discretionary is like muddling along, but the interesting thing here is that those consumer staples are running. Like this is an area that's just outperforming. That's clearly where that value over momentum trade is really gaining traction. But what you can clearly see is that these consumer staples are in very clear trend. Well, I'm not going to do them all, but what I wanted to highlight was one of your long-term darlings of the home construction.
Oh, that looks terrible. The home builders.
Look at the way it broke.
I guess they're very rate sensitive.
Yeah, and so what you had is a double top put in, and they really broke badly today. And the question here is that it some sort of short to intermediate top in on these home builders.
Doesn't look good because it looks like it's trying to do a triple bottom, which we know doesn't exist.
Yeah.
I know. What is it again? A triple bounce from. I can never do this to you. Whatever. You always make it sound so good. You can look at a chart. What is it? It's not a triple bottom because it's not a bottom. It's a triple. What is it?
Test of a key support line.
I don't know. You come up with such bullshit. You have such a great way of explaining. Of describing. Just like seriously, the guy can look at a chart. And, triple blah 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 blah. He comes up with all these things. I'm like, oh yeah, it's a chart. Okay.
All right.
Look at the energy. That's just going. It's just rocking.
Yeah, rocking.
It just looks. It's interesting because it looks so much like the financials. I thought it was the same chart.
Yeah, they're rocking, and even the crack index is turned back up. Like all these energy places, OIH, like this oil service, the whole oil space is turning back up. And this is one of the more interesting things to watch here. Let me just quickly pull up the oil chart because it's going to be one of the key things to watch is whether oil can actually break to a fresh new high. Now, I'm a seller on the idea that it does it in one fluid motion. I think it bumps its head up here along the overhead resistance. We're going to see it stall out a little bit, but I think that there's a legitimate chance that it does. And if it does, we're probably going to 85.90 on the upside, and these energy stocks might be able to really get some new traction on that. So I think that that's certainly something to watch.
I think you should take over from me since I called $100 oil in 2021 and I was wrong and never made it. I think you should. It sounds like you're a little bit of a bull there, so I think you should take it over. $100 in 2022.
All right, where I'm not going to say 100, but what I am watching for is the buy on dip to come in the coming weeks, and if it nicely consolidates and buys on dip, I'm going to make a call that it's going to 85.90, but I'm not making the call now.
That's such a typical technical analysis cop out. Okay,
no, it's not going straight up. What are you going to get?
No, I like that. That was good. That was good. But you got to be more like Jim Cramer. You got to just hit the buy button.
No, look. This is the wrong look. We were bullish oil off of 73. It had a great run, but you're buying it up at 80. There's into asymmetry in the trade until it pulls back. So I'm going to be buying dips though. Just one quick question: is this a new breakout in uranium?
Oh, it's looking good, isn't it?
Well, I don't know.
I talked to Cuppy this weekend.
Oh, he's getting
just foaming at the mouth about this.
Oh, well, let's get him on the show next week.
Yeah, we'll get him next week, but he's foaming at the mouth about the U.UN. He loves it. The SPUT, as they call it. The Americans call it the SPUT. Yeah, SPUT, right? Like, what does that stand for? Sprott Participation Uranium Trust? Is that what it stands for?
Something like that. Yeah.
Okay.
And so just one last little kind of look at gold, but clearly real rates are right now the pressure on it, right?
I think it's behaving pretty well considering how bad real rates behaved recently. I did notice, by the way, Morris sent me the confirmation that the Bank of Turkey was selling gold. So that might have been the seller.
Okay.
Now we got to turn them into buyers. Okay.
All right. I think that's enough for talking charts. We'll continue looking at them next week. But Kev, it's time
skin
for
in the
skin in the game.
Did you figure out who won?
Well, yes, and yes, because it was whether or not the USD CAD was going to be over under 128.91. You didn't even bother to look.
No, I didn't. I had forgotten. And so, where was it?
I crushed you. This is like taking candy from a baby.
It's like taking beer from a Kevin.
Yes.
Okay. Where was it? How close was I? Like not
you
even
weren't
close?
Not even close. It just completely went in my direction from the moment you made the call.
Oh, well, that makes it easy. It's also good because I don't have a bet lined up, so you've obviously been thinking about this. Oh, let me tell people about our bet, our little game that we play. Skin in the Game is a weekly opportunity for us to demonstrate that we are degenerate gamblers at heart. Every week, one of us presents a wager, and the other guy chooses which side of the bet he wants. Every wager needs to settle by the next episode, and the currency for the wagers is as follows: a Duke and Duke, or a Looney, as we know it up here, a pint of beer, a burger bet, a pitcher, a case of beer, 2 for a bottle of wine, no boxes, unless you're Cuppy coming back from Azores. Did I say that right this time? No?
Azores.
I keep saying it wrong. And then finally, the granddaddy of them all, the steak dinner, the moose dinner.
Yes.
Which we still haven't done because Patrick's busy gallivanting all over the globe. The winner of the bet is obligated to create a new bet for the following week. All wagers settle in full, and there will be no netting of positions. Oh, and by the way, everyone's asking about the huddle or the piss up.
Yeah.
In hindsight, we've closed our country again, so it's a good thing we didn't. But we're going to do it. We're aiming for what?
Early,
spring / early summer, because we don't want people to come to Canada.
What would be perfect would be a patio event.
Yes, I want to try to get an outside one just in case this. Like, I think this thing's almost done, but you never know. And
but it's generally a nice thing to be have a bunch of people out on a patio.
So we're gonna do it, late May, early June, right? Is that what we'll kind of around then?
I think that's a fair.
So just when everyone's thinking about things, if you want to come see Canada, I think it's before the bugs are out, so it'll be okay. Okay.
All right, Kevin.
So what do you got for me?
I'm gonna go to the asset that shall not be named.
Oh, you're not.
I am. I wanted something you might not be having an opinion too strongly about. Approaching 41,000 here. I'm just going to straight up over under, higher or lower.
God. You know, I went on Jack's show. I cheated on you a little bit.
Oh, that's fine. I cheat on you all the time. That's
I know you. I know you do. It's our open relationship. We're good with it. And at that show, I should have known I was in trouble when the name of his sponsoring company is Blockworks. He goes, no, I have full editorial discussion or authority. And I was like, okay. And so I sent him a couple of my pieces, and it happened to be right after that piece that I wrote about the long gold, short Bitcoin. And he proceeds to just jump into it, and we spend forever talking about this. And so let's just say I'm persona non grata in the Bitcoin community again.
Oh, you're about to get the hate mail.
Well, listen, nobody listening to the Huddle is surprised by this, so I'm not going to get the Huddle hate mail, but I definitely got the new Blockworks hate mail. I got told I was an idiot. I didn't know what I was doing, and that all the regular stuff. Good times. Okay, up or down?
Up or down.
Okay, so listen, I'm going to go up. Do you know why? Because I'm short. And so if it goes down, I win. And if it goes up, I win. It's a hedge. And I know. You wanted it because you saw it. You think it's got to hit some support.
All right, Kev. Let's make a bet. What do you want? What do you want to do?
Well, considering how much I'm short, I could probably do multiple steak dinners. If it's going to be a true hedge. But let's keep it fun. Let's get
a box wine.
A box of wine. No, let's do a picture. We need some pictures.
All right.
Because I don't think you wanted the other way anyways. You're looking for a bounce, aren't you?
I'm not going to say anything.
Yeah, you did. You thought it was going to bounce. You were trying to get me the other way.
I was hoping you were going to be bearish.
Yeah, I know. So we'll do a picture.
All right. Okay, so that's the bet. So
now let's get the real star of the show on.
Lena, help us out. No stupid questions. It's time.
Before we move on, though, I wanted to just point out you guys didn't discuss what Patrick was winning, what the wager was from that bet.
Oh,
do you guys even remember?
Lena? No, what was it?
A bottle of rosé.
Oh, that's right. And Darius told us that we can't drink it at this time of year.
Yeah.
But I think, and Lynn Alden was weighing in. We had lots of back and forth about whether it's drinkable.
Yeah, it is. I think it is. The consensus is it's a warmer weather.
That was the ultimate conclusion.
I think so. Yeah.
Well,
see ya.
Patrick and I, we just can't drink it regardless. So is that what I have to give him a bottle of rosé?
Yeah, you even talked about what is it going to look like when I go to LCBO to buy a bottle of rosé. That sucks for me.
All right, I want the video.
It's true. I'm going to be embarrassed. Like it's not only that, I'm going to be buying it in the winter. So it's not only is it a faux pas, it's a double faux pas.
You're buying a bottle of rosé for
Darius
a buddy of yours. Anyways, just wanted to point that out.
I'll just say it's my partner.
Oh, yeah.
Okay. Okay. So no stupid questions. Let's go.
All right.
So the first question here. Greatly appreciate the huddle. Question for Patrick. I recently joined Big Picture Trading and have been following your breakout trading strategy. In one of the videos, you said that you use short-dated puts, 14 days-ish, in your breakout trades, expecting that they will be rolled up if the trade works. Wouldn't a longer-dated option experience less theta burn over the 14-day period? I'm wondering if it would be cheaper to buy a longer-dated put option and roll it up at day 14 versus a short-dated put. Hope my question makes sense. Thanks for the show and Happy New Year.
Oh, that's a great question. But generally, it goes back to technical analysis in general, which is that when there is a technical trade that sets up, it doesn't take more than 14 days to find out whether the trade is working or not working. And so we use a shorter dated option simply to determine whether or not we should be in the trade or not. If you buy a longer dated option and the trade isn't working, then a lot of traders will often stick with the trade and tie up their money longer periods of time, hoping that it comes back. I find that if the trade isn't making you money in that 2-week window, then there just isn't. It's not worth sticking with the trade. You just punt it, go to cash, and emotionally reset and go find a new trade. I think it's a good rule of thumb. And even though Theta does burn more aggressively, those options are also somewhat cheaper, and you don't really want to be in a trade anyway if it's not working. So it's just something that we use. Anyway, that's all I have to say.
It's good stuff. Next question.
Next question. First of all, thank you for a great show. Many expect growth stocks to struggle in 2022. Some even predict a quote-unquote violent rotation, wink, wink, as a result of increased yields and hence decreased net present value, NPV. I can completely see that apply to the archetype companies around this companies of this world that are not expected to be profitable for many years to come. But what about more quote-unquote conservative growth stocks, e.g. a biotech company which expects to ramp up sales and become very profitable within a few years? Typically, such companies are valued based on the discounted income for the next 10 to 15 years and have on average a 15% discount rate applied. A 1% interest rate change would impact the calculated NPV by not more than 15 to 20% at most. Yet the XBI has fallen over 33% since its Feb 2021 highs, and many expect the decline to continue. Might this make for a contrarian buying opportunity, or, more likely, am I completely overlooking something? It would be absolutely great to get your thoughts on this. P.S. I heard the Alliance of Magicians whispering that XBI recently completed a 61.8 fib retracement to the COVID crash lows and is currently right back at the support zone that was built up during the summer of 2020.
Good observation.
A deep cut PS, a deep cut. They demand to be taken seriously.
I do demand it.
Listen, this is a great question. Before we talk about the technicals or the fundamentals, I just want to talk about sentiment. And I'll pass along a story that my buddy told me. He said, is a really shrewd buddy I have that just trades his own account, one of the smartest, kind of quietest guys that I know, but I really respect a lot of the things he says and a lot of the work he does. And he told me, he said, I went out for lunch with one of my buddies that manages biotech. And he was so down in the dumps. He was so upset and just it was like all the winds were out of his sails. And he said to me, he said, it was so bad that when I got home, I decided to buy some XBI. Because he said this guy was so pessimistic about his own. He was a portfolio manager on biotech, and even he was so pessimistic about his own the outlook. So I sympathize. This is a very down and out, really a sector that has disappointed a lot of people. And I would carve it out of the basket that I've created in that violent rotation talk. And I would say that XBI could very much trade on its own. And you shouldn't be worried as much about interest rates or a shift in the type of growth that we're experiencing, because XBI could go up regardless. That would be my feeling. Do you have a feeling, Patrick, you want to give us about the 61.8 retracement fib or whatever that thing is?
I'm pretty sure he made that shit up. But the interesting thing is, the interesting thing is that one of my favorite biotechs, Amgen, hasn't gotten caught up in this most recent downdraft. And the interesting thing is like one of the larger holdings now, the XBI is a very diversified basket of biotechs, and like the IBB, which has got a lot more of those large cap ones with larger weightings, but they're both obviously quite weak. But what's interesting is that one of the big holdings in the IBB has been Moderna,
Right.
and Moderna had that huge run up to like $500, and the thing has been just selling aggressively. It's down to like a couple $100, like it's like $300 off of its highs, and it's a drag on the index, right? And but you go and look, like a stock like Amgen that's already sold off is already showing signs of life. Like, I think that looking at the basket of biotechs, I think you have to be a stock picker in the space. I think you have to not buy the basket. I think you have to literally trade your own little group of biotechs that have nicer, cleaner charts. And in this one case, I don't think trading the ETF is a better choice.
Well, I'll take the other side of that. I think XBI is good for bounce. By the way,
it is good for a bounce. I mean, the thing has been murdered. Like, there's no doubt about that, right? Like, but I mean, right now, it's been murdered. That's it. Yeah. It could go down to 100. It's like under 100, but at some point the thing will be back to $120.
There we go. There's a perfect technical analysis answer there. It could go down, it could go up. Patrick, before we
it's
continue
likely
on,
to go
I just
down,
want you to know,
but it will be.
I wish I had seen this when we were doing our bet, but I just got an alert that Mike Novogratz has said that we have entered the buy zone.
Oh,
so that's why you were trying to pick me off on Bitcoin, weren't you? I want to know, though, if we've entered the buy zone, does that imply that we had entered the sell zone at any point, according to Mike?
Oh, that's a good question.
Yeah. Kaylina, save us before I get in trouble.
Yes.
Last question of the week. Given the incredible speed of markets today versus 1987, do you believe the Federal Reserve has traders on the desk ready to buy securities, be it U.S. Treasuries or stocks, in the event of an intraday market crash? For example, were they ready to buy on Wednesday at 2 p.m. when the Fed minutes were released, just in case of an outright crash in the stock market? It seems they must have learned something since the flash crashes, no? Or perhaps they've outsourced this quote-unquote plunge protection responsibility to Goldman or Morgan Stanley? Thanks.
So I will answer this one. There is not a chance that the Federal Reserve is reacting that quickly.
Yeah.
And I know that it makes great FinTwit to talk about the plunge protection team, and there's all these theories and out there that it doesn't exist. Now, what I will say exists is when things get really dicey and when we get into real problems, I am convinced that the Federal Reserve will tell influential brokerage firms like Goldman or Morgan Stanley or whoever that they'll give them a little wink. They'll say, we know it's a problem. We're going to fix things, and it's coming, and we're having a special meeting tonight. And I don't know exactly how it's done, but when we talk about the plunge protection team, that is what is truly the end client that's buying that. The other thing is that a lot of the other kind of, let's just say, buying that appears out of nowhere, all you have to do is listen to our good friend Jem Carson, and he'll talk about how a lot of these are actually market makers, and it has to do with options, and it has to do with those sorts of behaviors. And so long and short of it is, no, I do not believe the Fed operates with anywhere near that sort of quick moves. And if they do, the only thing they do is that they give the heads up to the actual brokers that eventually the policy will be changed.
Absolutely. I'll agree with you that the Fed itself does not have to do the stock buying. What they need to do is simply give some sort of a signal or something that gives traders knowledge that the Fed has put in the put. that they've got their back at this level, and then the market takes care of it on its own. The Fed itself doesn't have to do any buying, and more importantly, the point is that there's limit downs for a reason. I seriously doubt the plunge protection team is going to come in unless there were a couple limit downs on the market. So even a one-day intraday crash that went limit down wouldn't necessarily be a red flag that would trigger the Fed. I think we could easily go limit down one day and the Fed might come in the next day or something. Like, there's no need for them to be watching on an intraday basis.
And going back to your idea about the limits, it's been a long time since I've been on the institutional desk and actually seen what the clients did, but I can talk to you about what happened in the 90s when I was there. I remember periods when the stock market would get into trouble and we would actually be locked limit down. And I can distinctly remember the salesperson saying that whatever XYZ client is talking with their portfolio managers, they're making a decision. And they would be making that decision, and it would take sometimes a little while. And then all of a sudden, next thing we know, we would get an order, and it'd be a huge order. But the point was that took a few hours because they would have a little meeting. They'd all get together and talk about it, and then they make a decision. So the market will sometimes anticipate that there will be clients like that buying. But the actual real orders, they take a little bit of time to get there. And that's why you get flash crashes, like little moments where nobody is ready for it. And next thing you know, everyone's like, whoa, that's the wrong price. Or wait, there's going to be a big client that's going to like to own that. And it just ends up being, it's a much more complicated, diverse thing, but it's definitely not as conspiratorial as everyone on FinTwit believes.
Right. All right.
That's it.
That's it. So, Kev, give us a close, buddy.
Thanks for tuning into the Market Huddle. We appreciate you spending some time with us. Please give us a follow at the Market Huddle on Twitter. Lena gets tired of talking to Patrick and myself all day. You can listen to the Market Huddle on all the networks: Google Podcasts, Podbean, Spotify, Android Play, iTunes, and YouTube. A lot of people watch on YouTube to see all of our charts and visuals. And while you're there, please like and subscribe to get our latest content. And if you could, give us a like and a review on iTunes. It's a dumb game, but it makes a difference to Apple's algorithms, and it helps us out immensely. Patrick, where can they find you?
You can find me at bigpicturetrading.com or on Twitter at Patrick Ceresna. And Kev, where can they find you, buddy?
I'm on Twitter at Kevin Muir, or you can go check out my newsletter at themacrotourist.com. And listen, we can never have too many friends. Bear market, bull market, we're just happy to spend some time together on this crazy ride. So thanks for tuning in. Now stick around for the after show.
Right.
So let's do Patrick's beer.
You know what? It was very rich, and based upon my dizziness, it was definitely a high percentage beer. I'm gonna enjoy dinner tonight.
What do you give it? You got to give it your score.
You know what? I'm not gonna give it over 7.5. I'm gonna give it a 7.3. It was a good beer, but you know what? I'm not gonna give it an above average score.
Maybe you would have given it an above average score during Christmas season, since it's 2 weeks.
That's right.
No,
with the fruitcake.
Yeah.
I don't think so.
Do you like the fruitcake?
Ooh, you know what? I only eat fruitcake if someone gives it to me on a plate. I will never go out of my way to buy it, or if it's even on a. But even if it's on, but I don't know. Like, you know what?
If someone gives it to me, I find it's one of those things that Lena, you probably did. You ever have it?
Like fruitcake?
Yeah.
Like dried fruitcake during Christmas?
No, but yeah, like and then you put the rum sauce on it.
No,
and
not a fan.
Fire.
Not a fan.
Oh yeah, because so I love it. It's something I did all
it,
like.
I don't love it.
We did it growing up, and that's what I always eat. And at Christmas time, and my wife doesn't like raisins, so
I don't like raisins either. We talked about that before.
God, it's like,
I love raisins.
Yeah, see, Patrick, and my wife tells me that it's not a male female thing, and yet meanwhile, like 9 out of 10 of her friends don't like raisins, and everyone I know likes raisins that are on the guy side. So yeah, okay.
By the way,
butter tarts. Okay, so here we go. Butter tarts. Raisins or no raisins?
No raisins.
Raisins for sure.
No raisins.
Raisins
Ugh,
for sure.
Gross.
Do you know what?
Let's
you know what's
dry
strange?
this fruit and then we're gonna put it in something to rehydrate it. It just makes no sense to me. Why?
So was it New Girl where they put the raisins in their mouth like a squirrel and then keep it and make saliva and so they can make them nice and squeaky?
Ew. Nightmare. That is terrible.
Speaking of New Girl, I haven't actually seen that, but do you know that it's on Disney? And my wife and I are watching it from like the start, and it was solid right from the beginning.
I stopped
like
watching after like a couple of seasons, I think.
But the first season, and did you know that one of the Wayans brothers was the original guy on there?
Yeah.
And he only lasted one episode, and then he was on another show, and they thought it was getting canceled, and it didn't end up getting canceled, and so he had to go and get rid of, like, he had to leave New Girl, and then that's when they got the Winston guy.
Oh.
Yeah, like when you watch it right from the start,
why
you're
they
like,
did a weird switchover.
yeah.
Huh.
And it was, I looked up, I was like, wild. Anyways, it's a well done show, actually. I like it. I'm a fan.
It is.
I mean, it is on Disney Channel.
No, but it's solid. What are you guys watching? Well, Patrick's not watching anything. He's
what?
He's gallivanting around town. Patrick, tell us, New York City, how were Morris's recommendations of the restaurant?
Yes.
Oh, they were fantastic.
So tell us what Liam told you about the one restaurant.
Oh, it was one by this if by the sea and two if by land or something like that, and it was it. I don't know if it was Liam, but anyway,
Maybe somebody else told you. Okay, so
Yeah,
Morris gives
but-
you this recommendation.
Absolutely. So
Yeah.
I take the lady there, and the comment was, well, that's where it's a romantic restaurant. That's where everyone goes to propose, and I'm like, well, I'm not ready for that, and so then I go there, and no shit, within 20-30 minutes there's everyone's like clapping and everyone's like crying, oh my god.
Wait,
and
but
there's,
you knew about the comment before you went to the
Yeah,
restaurant.
Yes.
and he's
You
like,
decided to go
oh, bullshit. And like literally, it
well, we had
happens.
reservations already. Plus, we yeah.
You should have thrown a fit that she didn't propose.
So was it a good restaurant?
Yeah, it was.
Yeah, you
nice.
got to say nice things because Morris
No.
is listening.
Yep.
No, it was a nice restaurant. It was
Where else did you go?
Oh, you know what? My favorite bar is Valerie's. It's like up on 42nd or something, and
Yeah.
And they have this. It's a really nice, gorgeous bar, and they have the happy hour with $1 oysters, and that's like our thing. And freaking have like 48 oysters, just like sitting there slurping them back. It was
48. Yeah.
That sounds like
oh, they were
terrible.
awesome.
The other end.
No, what do you mean?
40-something oysters and alcohol?
Oh yeah. Oh, and they had like $10 martinis. Oh, it was.
That does not sound good. I don't know.
Yeah.
Oh my God, it was fantastic.
Yeah.
You guys, no, shame on the two of you. It was awesome. It was
The
awesome.
I have
New York
one of
was
my-
nice during Christmas. It was great.
Oh, New York's a great. Was it busy?
In the touristy areas, like it was quite quiet once you left the main. Like if you're on Fifth Ave, and you're like in the Rockefeller area, of course it's crowded as hell. But once you're just on the main streets, it was pretty quiet.
Yeah, and I was gonna say, did it seem like everyone had the vid? That's what I heard.
It seemed pretty fine. It was all right.
Everyone just like, what the hell? One of my favorite restaurants. I'm trying to remember. Is it Madison Square Park? Is that where, the original Shake Shack is? Which is one of my favorite restaurants. But
Oh my God.
fuck, I love the Shake Shack.
Oh jeez.
Did you go? You're in Houston, right? You got to go to the Shake Shack.
I will not.
Why?
Oh,
You don't
okay,
like the
fine.
Shake Shack? Like
Okay,
seriously,
fine,
what's
okay,
wrong
Oh,
with
it's
you?
beneath
I'll-
him now.
Oh, yeah, like I'm not gonna. They're not. go into a Shake Shack. Let me just see. Houston Shake Shack. What's Houston like? I've never been.
I've only been here for a few hours, so I'll
so
have
you don't
to
know.
give you. I'll give you a.
Oh my
rundown
God!
next-
They got like so many Shake Shacks. It's unbelievable. Where are you staying? I'm gonna set it up. I'm gonna send you the link.
I'm at the Hilton downtown.
Shake
Oh
Shack
no,
to
people can
Hilton.
come and stalk you.
Yeah, lots of stalkers.
Oh, you know what? There's plenty of. There's the big conference here, the George Gammon.
Oh, is that why
show.
you're there?
Yeah.
Oh, that'll be fun. Did you bring the tinfoil? I love George. He's a good guy. He's gonna take the
I've got
joke.
my
the tinfoil hat. Yeah,
I've got it. It's a mandatory thing to be down there. No, but
but anyways, I'll tell you. I was talking to this headhunter, and he's kind of an odd character, and he's a super nice guy, and he used to work at Goldman. And he says, okay, well, how about we go to Madison Square Park? I'll bring some beers. So I go to Madison Square Park, and we drink beers all afternoon. Then he says, I got to go. And he's like, takes off on his bike to Brooklyn or wherever. And then I'm like waiting for my next event. And I say, well, I got to, or meet or whatever. And I end up at this restaurant, this Mexican place. And it must be cheesy. I think it's this place, Mexique. And I loved it. It was the greatest tacos I've ever had. Or tacos, sorry. I just said it wrong. So I want you to go there next time, Patrick.
There was, oh my God, I'm trying to remember what the name of it was, but there was this one amazing Mexican place we went to as well, and it's eluding me. But
In New York?
Yeah.
Oh, well, you got to tell us.
Yeah, I'm gonna find it right now. But one of the one place we went for Christmas dinner was Benjamin's Steakhouse. It's a pretty well-known steakhouse in Manhattan there, and what like just typical fashion, they bring you all the frickin' bread and all of the appetizers, and you order a wedge salad and all this stuff like that. Then they bring me this massive ribeye steak, and I am full before I even get the steak on the thing. It's like it's like the biggest faux pas in going to a steakhouse is eating the appetizers and shit. Because fitting a ribeye into your stomach, that's a lot of work.
You got to do it like that Seinfeld episode when they went to India. You do everything backwards.
Yeah, you start exactly. You start with the steak, and if you have room, you eat everything else.
Yeah, for sure. Do you remember Kramer's lollipop kept getting bigger?
Yeah. I remember that episode.
That's a good episode.
Yeah.
Okay, well, listen, this is already long enough. Poor Lena's going to have a lot of editing to do. And
I'll remember the Mexican place for next
yeah, you got to tell us.
Yeah, for sure.
Okay, and you got to do it. And I just looked up my place. It's got 4 out of 5 stars, so it's not the worst place ever, but I'm sure all the New Yorkers are going, Jesus Christ, Kevin, you could have done better than that. I love New York, though. It's so much fun. Like, you just walk. What I love is how you can walk everywhere.
Yeah.
Like, that is, to me, I love the cities where you can walk. Like, I lived in Toronto, and we walk everywhere. It's great. Like, I think that I think there's not enough walking in this world.
There
Anyways.
you go. All right.
Welcome back,
it
everybody.
was
Thanks for tuning in.
great show.
Happy New
We'll
Year.
see everyone. Happy New Year.
Is it too
everyone.
late to say Happy New Year now? Like in Curb
No,
Your
I think-
Enthusiasm?
No.
This is the first episode of the new year. This
No,
is when
but-
we say it.
According to Larry David, you're only allowed 3 days.
Yeah.
But this is our first episode.
Okay.
We can't
Doesn't matter.
not-
Don't- I think
So what,
Larry
did
would
we
call
never-
us-
Yeah, it's a little
Yeah.
late.
Yeah.
Yeah.
Well, I think he would make an exception for this.
By the way, are you caught up, Lena? I haven't caught up this season.
Curb Your Enthusiasm?
Yeah.
No. I'm not caught up at all. I've actually been pretty occupied watching Bad Sport on Netflix.
What's that?
It's about athletes and their crimes.
You love the kind of pseudo documentary
Oh, yeah.
I
slash
should have been a
reality
detective. That's what
shows.
Luke tells me. He's like, "Are you gonna go into law enforcement? Like, what's going on?" But I like true crime stories. So.
Oh,
But it's
God.
definitely worth watching. It's episodic. I think there's like 6 or 8 episodes, and they're very interesting stories.
Nice.
Really?
Yeah.
One day when I start watching TV, I might.
Yeah.
It's
You're not
it's
gonna do
good. It's good. I think you should check it out.
You know what movie I did watch over the holidays? I watched one movie. I
Elf.
went back to the 80s. No, I watched Airplane.
Why did you watch Airplane?
Because I wanted a stupid comedy, and man, was that movie fucking funny! Oh my god! Like I haven't watched it for like a decade, and it's still as funny as the first time I watched it. It was so good.
I got a little bit of bone to pick with you, Patrick, because now whenever I'm like I got nothing to do, I'm upstairs and I'm like waiting for something to happen, and I'm just kind of killing time. I turn on Archer. It's my little guilty pleasure.
Oh my god, love it, love it, love
it's
it, love
so
it.
bad in terms of like it.
It's so bad. It's
so
good.
Politically incorrect. And
It's fantastic. It's
yeah, no,
fantastic.
I must say it's grown on me as it's gone along, and I just continue to like it. There's a reason there's 11 seasons.
Yeah.
Oh yeah, for sure.
Yeah.
It's good.
Also,
All right.
probably because it's cheap to make.
Anyway,
okay.
Happy New Year, everyone.
Take care, everybody.
Have a good
Bye-bye.
weekend. Bye.
Cheers. Bye.